Let's talk silver, everyone, and not that dig it up yourself kind of silver. This fireside chat is going to dig into the royalty and streaming model where investors are locking into the upside exposure to silver without those capex headaches, the operational risks, or, as we heard earlier today, talking about permitting delays, which are always a bit of a bugbear for everyone. And while we've got silver demand surging from both the green tech and the industrial sectors, the timing could not be better. So leading this discussion, we have from Tribeca Capital, Scott Clements, and partnering with him from Wheaton Precious Metals, would you please make welcome Randy Smallwood, who is the President and the CEO. Welcome to both of you, and take it away. Tim, would you please give them a warm round of applause? Let's settle in.
Thanks, Chrissy, and welcome everyone back, and especially welcome to Randy, who's come all the way from Canada, traveling through the region to be with us today. And I guess the first thing is, I know it's Singapore, but it's pretty chilly in here, and we're having a fireside chat. So I thought I'd get the guys to put on the fire, maybe, and we can sit here and relax in front of a nice fire to keep us warm.
How Canadian is that?
I thought you'd be a bit homesick. There you go. So it is actually a fireside chat. So I guess, Randy and I have known each other for 15 years or so now, and he, to his credit, was one of the first companies to really engage regularly with Asian investors, and he would come out here every year, and initially, and even still, I think is the case, the business model for Wheaton Precious Metals is not as well understood in this part of the world as it is in North America, where it's a very well-known financing model for commodity companies, and investors have seen what a great way it is to get exposure to the space. And so I think it'd be good for the audience, Randy, if you could maybe talk a bit about how the business started and how you developed this financing model, because you were one of the pioneers in the space to develop it, and maybe sort of a bit of Wheaton history and then a bit of a 101 on the business model would be great.
Appreciate that. Scott, thank you so much for the invitation. Honored to be here with Tribeca in Singapore, one of my favorite cities in the world. So always good to be back. And you're right. I was working for a company called Goldcorp 21 years ago, and we needed to raise some money to help grow Goldcorp. This is long before Goldcorp had reached its peak, and so we needed capital. But issuing shares can get a little bit dilutive, a little bit exhausting, and so we were looking for alternative ways to raise that capital, and that's where we originally came up with the concept of streaming. And I see, the title says royalty and streaming. We are a streaming company. We don't do royalties, because streaming is just a stronger business model. It's got much more flexibility, and it's focused on specific metals. And so there's just got a lot of attractions for all the stakeholders, both the operator, the streaming company, our shareholders, and all the rest of the stakeholders in the business. So anyways, we created this as Goldcorp. We had a mine down in in Mexico that had a lot of byproduct silver production. And so we came up with this business model where we supplied a bunch of capital to the streaming company, and for that we committed to deliver them, to the operating company, and for that we delivered them a percentage of the silver production at a fixed cost base. And so you can imagine the attraction from an investing perspective to actually find a profitable silver company. And that's essentially what the original Silver Wheaton, which was what the company was called back when Scott and I first started working together 15 years ago, was. It was a streaming company where what we did was focus on sourcing a byproduct, non-core byproduct silver from lead zinc mines, from copper mines, and from gold mines, and purchasing the rights to that non-core byproduct at a fixed price per ounce on a go-forward basis for a percentage of whatever that mine produced for the life of the mine on a go-forward basis. And so really that's what we did for the first 15 years, was help fund companies by supplying capital for a portion of their byproduct silver production. Back 2011, I took over as the CEO of the company and immediately expanded it to precious metals. Where I wanted to go with this company, we couldn't do it in the silver space. Silver is a very, especially compared to the rest of precious metals, gold really, it's a very, very small market. And so we've now expanded that business model now to where 60% of our revenue comes from gold, about 39% of our revenue comes from silver, and about 1% from palladium, and a little bit of cobalt from a small mine up in Canada. And so we still are one of the largest silver players in the space, but we have become truly precious metals focused. And last I looked, market cap of $35 billion on the New York Stock Exchange, the largest of the streaming and royalty companies. And I was a bit surprised to see we're actually the third largest precious metals company in the world now. So we've had great success. It's a strong, strong business model, really attractive, especially in today's world for investors that are trying to dip their toe into the precious metal space, because we're such a low-risk model. It's one of the key aspects that we deliver to our shareholders is we manage the cost risk. And we do that by, first off, investing into high-quality assets that have good operating margins for our partners. That's very important. Our partners have to be healthy, have to be strong, because that's what causes them to reinvest into these things through exploration and expansion. And so we've got an incredible portfolio, and we're always looking for ways to reinvest that capital into growing that portfolio going forward. So a good, strong business model.
Yeah, no, it sure is. And I think investors who've looked at it and seen the historical performance of your company would agree that it's one of the best ways to get exposure to the sector. And I mean, yesterday I had a slide up looking at the valuations of mining companies, and so it's sort of 0.5 EV to net asset value or something, and you get them around 1 times NAV in a bull market, but these streaming companies like Randy's, they trade well over net asset value because there's so much investor demand to get exposure, because you have no downside cost risk like you do on an operating mine investment, and you have upside optionality if the assets live longer, and so you really get the best of both worlds.
Well, it's even stronger because of the nature of our agreements. Typically, higher commodity prices will always bring costs up for an operating asset. And it's just simple math says that lower grade material becomes economic and therefore needs to be processed. But it's always going to have a higher cost per ounce or per pound in terms of what's being produced. And so the real advantage in the streaming space is, of course, our costs are fixed and defined on a go-forward basis. And so we don't have exposure to inflationary pressures. We have most of our contracts have a fixed price with a 1% accelerator every year as a production payment going forward. More recent contracts, we have a fixed margin of 80%, where we just pay 20% of whatever the spot price is. So a little bit of exposure, but a fixed margin of 80% is a very, very healthy financial arrangement on a go-forward basis. And so yeah, it's a good, strong model. It's got advantages over the royalty space from an investing perspective, because that production payment gives us leverage on commodity price. We are paying that base production payment, so we will outperform, and we have outperformed the commodity itself, and we should. And then, just other aspects in terms of the exploration potential. These are life of mine streams, and so when exploration success is delivered from these mines, we continue to get our share of that metal.
Yeah, and one of the stats that I always liked about your company was in terms of revenue and market cap to number of employees. It's just the most compelling ratio you've ever seen. So how many people do you have working for you now, Randy?
We're 42 people. So if you look at it in Canadian dollar terms, we're well over $1 billion Canadian dollars per person in market capitalization. and it's important to comment, just to sort of reinforce something that you mentioned earlier on, in terms of looking at us and saying, "Wow, but you traded at a premium." I actually sort of beg to differ that front, because we only trade at a premium if you're using the same risk metrics that you use for a mining company. And you highlighted it by saying that we are a much lower risk alternative. And so I actually don't think that we should be measured using the same risk metrics that a mining company uses. And I think, definitely, although we don't have any debt, we have a $2 billion revolver in place with about 12 different worldwide banks that feed that revolver. And I can tell you that debt, the interest that we pay on that debt, is really a reflection of risk because it's dramatically lower than any mining company would achieve. And so there's no doubt, I actually think the risk metrics that are being used to measure us should be dropped. We should be using a lower discount rate to value us. I don't think we trade at a premium. I think we actually, on a relative base, I think we're just such a low risk enterprise that it's a fantastic way. Wheaton should be the foundation investment into your precious metal space, where you keep that stable portion of your portfolio, and then you can play with some higher leverage, riskier exposure to ride the wave. But the combination of the growth that we have, 60% growth over the next 7 years, the margins that we have, the leverage that we have, and the silver exposure that we have. We should probably talk a little bit about silver sometime during this silver talk. All of that just adds up to giving a great exposure to some torque in the space.
Yeah. No, it's funny. We rarely meet CEOs that think their companies are undervalued, so I'm just kidding. We'll get to silver in a minute, but I think, so it's a great model for investors, but why do mining companies do deals with you? What's the advantage for the mining companies?
So in today's world, I mean, obviously, if you've got a number of operations in today's world, depending which commodities you're producing, but most mines are actually doing relatively well, and especially if you're in the gold space, you're doing very well right now with commodity prices. If you're not making money in the gold space right now, something's wrong. But even in broader commodities, commodity prices are doing relatively well. Most mines are actually cash flow positive, generating a lot of internal cash flows, and that's always what they should use first to fund their growth on a go-forward basis. And so, to be honest, for our growth, most of our success has come with single asset development companies of late, companies that don't have access to internal operating cash flow. So where do you get the capital that you need to grow, to build your mine, to advance this project forward? You can go to the markets. As you mentioned earlier on, most development companies trade at a discount to the net asset value, 0.3 to 0.5 times net asset value. Depending on the asset, depending on the quality of the asset, the team, you might have some higher valuations, and you've got some pretty impressive companies that are at this conference. But nevertheless, they still trade at a discount to net asset value. So issuing shares is diluting your existing shareholder base. Let's remember, we work for our existing shareholders in the hopes that they're future shareholders. We don't work for our future shareholders. And so, that's expensive in today's world. Bank debt, if you're a single asset company, you're not going to get the mainstream banks. This is going to be high yield debt. It's what I've seen around the world as high as 20%, 15 to 20%. Those are pretty expensive debt facilities, and they're very rigid. They're not very flexible. A streaming partner and a stream itself, first off, we take operational risk. We get a percentage of whatever is produced. So if it's not as high as you expect, at least it doesn't give you that overhang, that deadline of a debt payment that you have going forward. And streams are typically valued at around 1 times net asset value. So if you have a company that is corporately trading at about 0.5 times net asset value, and you can take a component, a non-core, ideally if it's a base metal mine that's got a bit of gold byproduct production, you can take a non-core byproduct and crystallize that value at 1 times NAV. That's a net positive in terms of financing growth going forward. And it's probably best exemplified by Montage Gold, which is part of the Lundin Group. I know you've got some Lundin members that are here at this conference, but Montage is part of the Lundin Group. Lundins are a major shareholder in it, along with Zijin out of China. We just met with a couple of days ago, and they're very happy with it. We essentially supplied a stream to finance that entire mine construction. So you can imagine a single asset development company that doesn't have debt coming forward and going through that construction. And we're a partner with them. We're flexible. We've studied the project. I'm a geological engineer by background. We're very, very technically driven. We're actually a production partner in building this. And just imagine that perspective. It's such a unique perspective to be able to actually construct that mine and not have debt overhangs. Right? It's one of the key aspects for it. It's a very, very attractive deal for Montage, where as soon as they a very high margin asset, they will be generating significant cash flow, which helps them grow. We're looking forward to expanding the partnership with them on a go-forward basis. So a stream will always dramatically improve the internal rate of return of the operator's project on a go-forward basis, dramatically. Our flagship asset, which is the Salobo mine down in Brazil, owned and operated by Vale, we supplied 75%, close to 80% of the capital to build that mine. We take away about 20% of the revenue. Vale shareholders, the return on their invested capital is phenomenal. They get it back every year on a mine that's got a 60-year mine life. They get more than their capital back every year. And so that's the attraction of streaming, is it makes a good mine a better mine from financial metrics. And you're working with an operating partner, not a bank.
Yeah. Well, we could talk about the streaming business for ages. But we should talk about silver, and that's the genesis of the company. It used to be called Silver Wheaton, and before you became this $35 billion market cap company. And so, the theme of the conference is future-facing commodities, and it's kind of I think the term means different things to different people, and I think silver sometimes gets lumped together with gold and not fully understood. But having been a silver buff for so long, how do you see silver's role in energy transition and end users, and has that evolved over the years that you've been in the market?
I just spent 3 years as the chairman of the chair of the World Gold Council. And I think it was actually CNBC Singapore that I was on one of these live feed interviews, and they asked what my favorite metal was, and I said silver. And what? Aren't you the chair of the World Gold Council? I still like silver better. Silver is a unique. First off, it is an affordable precious metal. It gets binned into the precious metal category, but it's not being treated like a precious metal right now. Right now, it's trading more like an industrial metal. Happy to report that my own personal belief, may be biased, is that silver is the ultimate critical mineral. The more silver we use in our high-efficiency electronics, in mobile electronics, the better they perform. Silver has the highest conductivity of any native metal out there in terms of that. So just a little bit of silver blended into your copper wiring dramatically improves your conductivity, dramatically reduces your resistivity, and it allows solar panels to be more effective at producing energy. It allows mobile phones to have either longer battery lives or more processing power, or both. It allows electric vehicles to travel farther, to reduce that range anxiety that makes it so hard for people to transition into electric vehicles. The more silver we use, the better the world is. Simple as that, and that's one of the reasons why 2/3 of silver that is now mined is being consumed as in industrial applications, even in water purification and antibacterial applications. We're seeing continued silver growth. What we're missing in the silver space is the retail demand, the investor demand. There has been recently some talk from some of the central banks about potentially silver being an alternative to gold, with gold's run up in price. We are seeing a ratio that we've never seen before in terms of what silver is trading at versus what gold is trading at. Silver always lags gold. I'm just surprised it's taken this far. It's lagged this much now where we see this ratio. And so, silver has much higher beta, tends to move more than gold. Beta goes both ways, so you do have to be sensitive to that, but I just think there's so many positive metrics behind silver, and we've seen peak silver production. 2017-18 was the peak of silver production. The one attribute that silver that made it really good for the streaming business is that about 70% of all silver is not produced at silver mines. Most of it comes from lead zinc mines. About 40% of all silver is produced as a byproduct at a lead zinc mine. We just don't see a lot of new lead zinc mines being built in today's world. And another 20% of silver actually comes as a non-core byproduct from copper mines. It makes it the perfect material for streaming, but it also limits the supply side response, and that's one of the reasons why silver has higher beta, higher volatility than a lot of other commodities out there. And so silver's time is coming. It's been strong for a long time. And you know, it's trading at a reasonable price right now. There's a lot of profitable silver companies out there. As I said, 39% of our revenue last year came from silver at a cost of around $5 an ounce. I think we're paying right now, close to $5 an ounce. And so, you know, we're doing very well off of silver. We've got a lot of silver growth in our portfolio. So, you know, I do predict going forward, we might gain a little bit more on gold, but we'll always have a healthy silver presence in our company. And yeah, it's my preferred metal. You know, the fact that there's less supply out there and increasing demand, if it ever wakes up again as a precious metal and starts to bring that back in, we're going to see a big move in silver.
Yeah, 100%. And I think for investors, it's hard to find pure play silver exposure, to your point that it's mostly created as a byproduct, and that's, you know, part of the reason why you've, you know, had such a great investor following and resulting valuation. So I think Chrissy's standing up. I guess we're on the hook here, but so we'll close it off here. But just wanted to say thanks again, Randy, for joining the event. It's been great to have you here, and we've got another similar Australian story coming up and coming with Deterra. So and then we're going to get into the copper part of the program. So anyway, thanks very much, Randy. That was great.
A real pleasure. Thank you.
Thank you.
Thanks, fellas. I like your picture of the fire. Yeah. Absolutely wonderful. It shows it really, really well. So you know how that works? When you actually see a picture like that of something walk, it sort of taps straight back into your memories of being warm, sitting in front of a campfire, and your brain opens these little neural pathways, and that triggers a heat response in your mind. So you feel cozier, even though technically the temperature hasn't gone up. Although I did walk outside and demand they stick the temperature up. So they've promised that they have. I hope you feel a little bit cozier visually and actually in reality as well. All right, we have heard how the royalty and streaming model is delivering serious value in silver. So now we're going to take that up a little notch. Deterra Royalties is Australia's only ASX-listed royalty company. They have cornerstone exposure to iron ore through Mining Area C, and they've got a growing reach into lithium, copper, mineral sands, and much, much more. They've got scalable margins. They've got minimal capital risk, and this really is the royalty model working at its best. Now, this is Deterra's second year at the conference, their very first year up here on stage, and talking us through this story and this opportunity. Would you please welcome Julian Andrews, who is their CEO. Welcome, Julian.
Thank you very much. Thank you. It's a pleasure to be here. For those of you who aren't familiar with Deterra, we're a diversified resources royalty company. So Randy and Scott talked a bit about the business model more generally, but clearly from a streaming perspective and with a bit more focus on a particular commodity. So from our perspective, we're looking to bring what's been a very successful business model in other parts of the world, and particularly in North America, to ASX. We're listed on ASX and have been since late 2020. And with a market capitalisation of about $2 billion Australian, we're part of the ASX 200. We have a portfolio of royalty and royalty-like assets that sit across a range of commodities, as we just heard, with a core focus on iron ore, but broadly a focus on bulk base and battery metals. So we're not focused on precious metals in the same way that Randy and his company are, and many of our peers. We're looking to do something similar, but across different commodities, delivering the same benefits that the business model brings. We have substantial cash generation capability, and in fact, in the 4.5 years or so since we listed in late 2020, we've generated a little bit under $1 billion Australian of revenue. Consistent with the model, which is a very light, scalable and very light overhead model, we tend to operate at very strong earnings margins. So historically, we've reported earning margins in the mid-95%, EBITDA margins in the mid-95% range. And you can see on the chart here up on the left-hand side of the chart, that causes those revenues to flow through pretty directly into earnings. We heard a bit about the business model, but to be clear, it is really a very simple and compelling investment thesis. We provide our investors with top-line exposure to mining, but with very little exposure to operating expenditure or capital expenditure, and what is in effect an option or a free carry into extension or expansion of underlying mines. We have a mix of high quality cash generating assets and good quality development assets that support our shareholder returns. And we have a consistent and patient and disciplined approach to creating additional value by adding further investment opportunities into the portfolio. It's worth perhaps just talking a little bit more about the royalty and streaming model, and the economics are similar, although there are important differences. To be clear, we are much more focused on royalties than we are on streams. So a royalty operates, as I'm sure you're all very familiar, essentially it gives you a slice or a piece of the top line revenue of a mine. And in doing so, it provides a way to invest in mining with some key structural advantages. And in particular, as a royalty holder, you get exposed to underlying commodity price, you get exposed to the production volumes that are coming out of mines, but you don't have exposure to operating expenditure, you don't have exposure to margins, you don't have exposure to capital costs and other elements that go along with operating a business. So it's a financial interest rather than an operating interest. That protects you against cost inflation, and in fact, cost inflation can sometimes be a positive factor. To the extent that cost inflation is reflected in higher prices, that will be reflected in higher royalty payments. I mentioned, that the other really core component is that as a royalty holder, where you have a right to receive revenues over output from a mine, to the extent that the miner is expending in expansion activity or is investing in extension of mine life, you get to benefit from that expenditure without having to contribute to it. So it gives you that optionality upside along with that cost protection. As I mentioned, we have a portfolio of a number of different royalty and royalty-like assets. We have two key assets. One is a gross royalty, a gross revenue royalty that we hold over BHP's Mining Area C operation in the Pilbara in Western Australia. That's our foundational asset and really the asset around which the business was established and around which we're looking to build out the portfolio. I'll talk a bit more about that in detail. The other flagship asset we have is an asset that we acquired last year, which is a gross revenue royalty over the Thacker Pass lithium project in Nevada. And again, I'll talk a little bit more to that in a moment. As you can see from the charts, we have, we are still very heavily weighted in exposure from a revenue perspective to iron ore through that Mining Area C royalty, but we also have exposure to other commodities from a revenue basis and also from a valuation perspective. Across the portfolio, you can see we have assets sort of globally in Australia, North America, South America, and some in Africa. But the majority of the portfolio is located in North America or Australia, so good quality geographic exposure. I mentioned the Mining Area C royalty. As I said, that's really the core asset around which our business was founded. For those of you who aren't familiar with Mining Area C, it's one of the 4 iron ore hubs that BHP operates in the Pilbara as part of their Pilbara iron ore system. It's the largest one of those 4. And in fact, following the recent completion of the South Flank expansion at the mine, it's now the largest iron ore operation in the world. It has an annual capacity of 145 million tonnes a year, which, to put that in context, that's about 9% of the total global seaborne iron ore trade each year. So very, very large operation. It's long life. BHP's talked about operation there continuing into the late 2040s or early 2050s. And in fact, in some of its filings, its EPA filings, it's talked about operations going potentially as long as 2070. You can see again up on the left there, we've got a little chart that shows the royalty area. That's the polygon in the orange outline. To be clear, we're entitled to a revenue over any product that comes out of there. All the blobs on the right-hand side of that map are the current operating mines. The ones on the left are other deposits that have been identified but are not currently being developed. So there is still some further optionality in the asset itself, in that if those deposits ever are developed by BHP and its partners, we would continue to earn royalties from it. We have a 1.232% gross revenue royalty, so we're entitled to 1.232% of FOB Aussie dollar denominated revenue out of the mine. There's also a second leg to it in that we actually receive, I mentioned before about how as a royalty holder you're not on the hook for any capital that goes into expansion. In fact, the nature of this royalty is that we get paid to the extent that BHP expands production. So there's a capacity payment that pays us $1 million Australian for every 1 million tonne increase in annual production. That's a ratchet effect, so as production, if it gets over the high water mark from previous years, we're entitled to further payments. So another nice little element to the royalty arrangement. So look, I never get tired of saying this. This is a really world-class royalty asset. If it's not the best royalty asset in public ownership out there, it's certainly one of the top 2 or 3. It is over a world-class deposit in a world-class mining jurisdiction operated by the world's largest miner. It's got multi-decades of life ahead of it. It's got potential expansion or extension potential at some point down the road, and it is generating a lot of cash for us. So in the last full financial year, this asset alone generated about $240 million Australian of revenue for us. So a very, very high quality asset. As I said, that was the foundation asset on which the business was really built, but clearly an important part of the business model is to expand out our portfolio and build around that core asset. In that regard, I touched on sort of the breadth of assets we have, but the other asset that I'd just like to highlight this morning is an asset we acquired last year. We closed on this acquisition in September last year, and it is another gross revenue royalty, and it's over the Lithium Americas General Motors Thacker Pass project in northern Nevada. Now, we really like this asset because we see that it has a number of Mining Area C royalty-like characteristics. It's a very large deposit. It's long life, it's in a good mining jurisdiction, and it's very well supported by its operators and customers. So again, perhaps to put that, to put a little bit more meat on the bones in that regard, it is Lithium Americas describe it as the world's largest known lithium reserve. It has a very long life ahead of it. In fact, in January this year, Lithium Americas put out an updated 43101 technical report that outlined an 85-year mine life. It outlined a production plan that has significant optionality and expansion potential. A phase 1 that of 40,000 tonnes a year of battery-grade lithium carbonate, going up through 4 phases of expansion to 160,000 tonnes a year. Obviously in a great mining jurisdiction in North America. It is, and to be clear, it's not in production, but it is fully funded. In many ways, as a royalty holder, it's done absolutely everything we could ask of it from a royalty. So in the period since we acquired it last September, we've seen over $3 billion US of funding close on this project. We've seen the updated 43101 that I mentioned that doubled the mine life and the production output. And then just a couple of days ago, Lithium Americas and General Motors, who has a project level interest in the project as well as offtake, announced they'd reached final investment decision. So this project's now in construction. It's expected to begin production in late 2027. So given the scale of this project and its longevity, we see this as being a really important contributor to our portfolio for many, many years to come. As I said, an important part of the business model is to continue to invest, to continue to add high-quality assets to our portfolio. And we have a consistent and patient and disciplined approach in that regard. As I said, we're a little bit different from many of our peers in that we don't focus on the precious metal space. Randy and his company and others do that very well, so we don't look to compete head-to-head in that space. we are focused on a different commodity suite. So we're focused on bulk, base, battery and electrification commodities. We have the other key point of difference, certainly in that space, outside of the precious space, an important point of difference for us is our ability to be able to invest at a meaningful scale. So that cash flow generation that I talked about provides us with the liquidity to be able to invest at a meaningful level. So we're looking for investments in that sort of $100 to $300 million Australian range, so call it 60 to 200 US. Which, as I said, is quite an important point of difference outside of the precious metals players. We look for those opportunities either through acquiring existing royalties that maybe they're held by a non-natural owner, or it may be from time to time there are consolidation opportunities that might come along, or similar to how Randy described it as well, by serving as a source of capital for miners, whether they're looking to invest in their own operations, get a project built, so sort of a traditional project finance role, or whether it's about balance sheet repair, or whether it's to support mining M&A activity itself. So as I said, we certainly have the appetite to continue to grow our portfolio, and we have the capacity to do so through the liquidity that we generate. And in that regard, our capital management framework is designed to support both that further investment, but also balance that with returns to our shareholders. And we have, our capital management framework is one in which we look to, we're targeting a minimum payout ratio of 50% of our earnings, and then the sort of subject to our needs around investment and balance sheet repair. So we recently, in February, we announced our interim dividend for the first half of FY25 at 9 cents per share. That's about a 75% payout ratio. So we're looking to grow the business while at the same time looking to really return capital to our investors. So we're almost out of time, so maybe just to wrap up, as I said, it's a very powerful business model. We're bringing it to the ASX. And we're doing that through having a really high quality portfolio of royalty assets. We give our investors that top line exposure to a world-class iron ore operation, a world-class lithium project that's in development, and are looking to expand upon and build that portfolio. So look, thank you very much, and I think I'm out of time, so I'll just wrap up there. Thank you.
Thank you very much, Julian. It's a really compelling investment opportunity for all of us. We're going to change gears now. We're going to shift our focus to the companies that are exploring and mining the minerals that we need to power our future. And as mentioned at breakfast, we're going to start with copper. So Terry Scarrett will remember. Who was at breakfast this morning? Were we all at breakfast? So one of us, two of us, fabulous. Scott and I were there. Scott and I know. Some of the key marks that he gave us in that keynote this morning, he reminded us that without copper, there is no energy transfer, and that we will need 61 new copper mines to meet that growing demand. So diving straight into it, and we're starting with a company that's giving investors direct exposure to one of the most compelling high-grade copper-gold discoveries coming out of Argentina. Please welcome NGX Minerals President and CEO, Wojciech Wodowski. Welcome, sir.
Well, good morning, everyone. It's a real pleasure to be here in Singapore and introduce, I think, for the first time for many of you, NGX Minerals, which has been one of the most exciting exploration stories in the world for the last couple of years, and through the longer history of NGX has really proven just how much value can be created by an exploration company. So this is a model that may be new to some of you. We're not a revenue generating company. We don't pay dividends. However, we have been able to generate very significant returns for investors over time. So the original NGX, which started out in 2008 when I first started with the company, has made a series of discoveries. Some of those discoveries have been spun out and then subsequently acquired. And then the current NGX holds a number of other significant projects that we'll talk about today. But the combined value creation for NGX and its spin-out companies is north of $8 billion Canadian over that time period. So exploration can really generate very significant value. And what I want to do today is talk about what NGX is going to do from here on out with the super exciting projects that we've got in the portfolio right now. So we're listed on the TSX, NGEX. Current market cap is around $3 billion Canadian. So like most other speakers here, I'll be making a bunch of forward-looking statements. Definitely encourage you to review those on our website. So the NGX projects are part of what's called the Vicuña District, which is South America's newest major copper-gold district. It was discovered by the original NGX, and then NGX holds the last independent projects in that district. As some of you may know, the other two projects in the district were recently acquired by a combination, a joint venture of BHP, Australia's largest mining company, and Lundin Mining. And NGX holds the remaining two projects that are outside of that joint venture. So we really are the last independent piece of this puzzle that's being put together by a couple of the world's largest mining companies. So we've got two main projects, Lunahuasi, which is a brand new discovery. We've got phase 3 drilling underway there right now. We'll talk about that in a second. This is probably the most exciting new high-grade copper gold project in the world right now. We also have the Los Helados project, which is a much more advanced asset just across the border in Chile. The entry of BHP into the district has definitely been good for all of the players. It answers a lot of the questions about infrastructure development, and just having a big player like that in the district, I think, adds a lot of credibility to the play that we've been putting together over the last 15, almost 20 years. The little map, which we'll look at in larger format in a few slides, shows the 5 main deposits in the district. The Caserones operating mine, which is owned by Lundin Mining and JX Nippon, just to the north end of the district. Our Los Helados project, 15 kilometers to the south. Our Lunahuasi project, kind of right in the middle of the district, just across the line in Argentina. And then the Jose Maria Filo del Sol projects, both NGX spinouts, now owned by Lundin Mining and BHP. So we're going to quickly run through our two main assets. Lunahuasi is the one that's attracted the most attention over the last couple of years, and that's because it's probably the highest grade new copper gold discovery anywhere. There really hasn't been anything like this for quite some time, and that's what's generated our market outperformance over the last 2 or 3 years. You can kind of read the grades there for yourself. I'm not going to go through those, but just to give you some context, the average big copper mine in this part of the world, which is the source of around 40% of the world's copper, the average grade is somewhere between 0.5 and 1% copper. So when you look at these kind of numbers that you're seeing here, the 7.5%, 2.3, 5.1 over significant widths, it kind of gives you a sense that we're looking at something that's an order of magnitude better than average. Our Los Helados project, also part of the district, this is a much more advanced project with measured and indicated resources that you see labeled there. So very significant copper, gold, and silver deposit. So as I mentioned earlier, that same map that we talked about, a little bit larger there, and then a regional location map. So we're in northern Chile here, about 1,000 kilometers to the north of the capital city of Santiago. We're in a major mining district with a lot of operations around us, including the operating Caserones mine owned by Lundin Mining. So what makes Lunahuasi unique are these 3 things that you see on this table. It's unique in the district, and it's a very rare kind of generational discovery. The key characteristics of it are unusual grades. You can see that in the orange column there. Some of the these are kind of chronological intercepts. So the very first one is the discovery intercept, and then you can see as we've stepped out up to 1 kilometer away from those discovery intercepts, we're continuing to hit significant intervals of very, very high grades. There's also a significant scale to this. Sometimes people see high grades and they automatically think it means relatively small. That's anything but the case at Lunahuasi. There are big, long intervals that are still 2 or 3 times the average grades for this kind of deposit. And then finally, there's a very, very significant gold component here. This is primarily a copper deposit, but these gold intercepts that you see here would not be out of place at some of the highest grade gold mines in the world. So we're right now in the middle of our phase 3 drill program. This deposit was discovered just almost exactly 2 years ago, so we've done 2 phases of drilling. We're now on the 3rd. At the end of phase 2, we had tested an area with the dimensions that you see on the map, around 400 by 900 meters, and we'd tested up to 1 kilometer below surface. That red box that you see there was open in every direction. This is kind of what you see, that same red box imposed on a photograph of the area. So the area that's been tested is inside the red box. And then not going to go too much into geology, but I think you can see that the rocks outside the red box look pretty much identical to the rocks inside the red box. And that area outside is where we see the exploration upside. And that's what our drill program that's currently underway is doing. So all of that area outside of the red box that you see there is kind of that light yellow area, and that's being tested by the drill holes that are outlined in blue. So that original 400 by 900 meter area are the red holes that you can just sort of barely see in the middle there, and then the blue holes are part of the step out and extension program that's currently underway. So we've got 8 drills turning right now. We've drilled around 16,000, 18,000 meters of what's ultimately going to be probably north of 25,000 meters drilled by the end of May. And the results to date have been outstanding. They've continued to confirm this is a really significant discovery. And now we've defined similar high-grade mineralization over an area that now measures about 1 kilometer by 1 kilometer by 1 kilometer, so significantly expanding on that original area. I want to just quickly run through our second asset because it's a really important part of the overall value story for NGX. Los Helados is significantly more advanced than Lunahuasi. It's a more typical copper deposit for this region. Average grades are around that 0.5% average that I talked about earlier. We own 69% of this project. JX Nippon, Japanese group, smelting group, is our partner on this. And that deposit is located around 17 kilometers from an operating mine owned by our sister company, Lundin Mining and JX Nippon. So much more advanced. There's close to 100,000 meters of drilling into this as opposed to the 30-odd thousand meters that we have into Lunahuasi. There's been significant historical engineering, metallurgical work. It's a big resource with the contained copper, gold, and silver that you see below. And we see the most likely development scenario for this project as some kind of integration with the operating infrastructure at Caserones. And what that means is that Los Helados would, subject to a deal, would be one of the cheapest projects to develop globally because it could take advantage of that existing operating infrastructure. The Caserones mine has around 8 years of mine life remaining. It's significantly lower grade than what we have at Los Helados. And we see Los Helados as an important way to extend the life of that existing infrastructure by decades. So NGX has been a great value creation story for shareholders. I mentioned that at the beginning. We started out with a 40 million market cap way back in 2008. Over the years, we did a series of spin-outs. Filo Mining first, that was recently acquired by BHP and Lundin Mining for $4.5 billion. We did a subsequent spin-out of the Jose Maria project, which is now part of that BHP Lundin Mining joint venture. And then NGX has a current, with the remaining projects that we just talked about, has a market cap of around $3 billion Canadian. So, you know, it's somewhere around $8 billion worth of value created and counting. So just to give you a sense for what an exploration company like this can do for shareholders. The NGX share price since 2021 has significantly outperformed copper. The copper is the little blue line that kind of runs along the x-axis there. And I show this slide because, you know, what I want to illustrate is that our share price performance really hasn't had any help from the copper price. And if you look at the performance of gold companies recently, you can see that you know, when the commodity starts to move, that can really turbocharge a stock like this. But to date, you know, we really haven't benefited from that yet. And so that fuel is still something that's out there for when the copper price moves at some point in the future. So providing additional upside to investors. So, it's been a great story so far, but we strongly feel that there's still a lot of value to be created here as we advance the Lunahuasi project, as we potentially look at monetizing the Los Helados project. So the way to think about value, we feel, there's been a bunch of recent transactions in the district. Those are all shown in black. We think Los Helados is directly comparable to Jose Maria. It's a significantly larger resource, it's significantly better grade. The recent BHP transaction valued Jose Maria at about 1.4 billion US. We don't see any reason why Los Helados should be worth significantly less than that. Lunahuasi, slightly different deposit type, much higher grade, but we don't see any reason why that shouldn't end up with a valuation similar to the Filo del Sol project, which just went recently for 3.3 billion US. So you add up the two NGX assets, and we see a lot of upside from our current US 2 billion or 3 billion Canadian market cap. The assets are very strategically located in the heart of a district that is now being developed by the world's largest mining company in partnership with Lundin Mining. That's going to bring in a lot of infrastructure to the district. I think that rising tide will float all boats, including ours. So that concludes my formal remarks. I can see I've got a few minutes here, so I guess if there's questions, I'm happy to answer them.
Did anyone have a question? Wojtek does have 2 minutes up his sleeve. Is there a question you'd like to fire at him from the audience, anyone? I think we can yell out. Or do you want to go and have that conversation with him at the booth? I think they're going to keep their investment cautious.
Well, I guess the last thing I would say is that we're here all day today, and if this presentation piqued anyone's interest, we're certainly available at the conference for a more detailed follow-up with anyone that might like that.
Well done, sir.
Thank you very much.
No guts, no glory. I like
Yep.
it. Well done. Would you put your hands together for Wojtek, please? All right, copper option number 2. If you're looking for leverage to copper with a serious global ambition, next company should be on your radar, Sandfire Resources. They have just locked in a sizable revolver facility. They've secured a legal win in Montana that clears the way for future growth. So here to unpack what that may mean for us as potential future investors, would you please make welcome the Head of Commercial for Sandfire, David Wilson. Welcome, David.
Thank you very much for the introduction. And before I begin, I'd just like to thank everyone for the warm welcome we've had in Singapore this week. And I'd like to also acknowledge the First Nations peoples of the lands on the lands we conduct our business right around the globe. I think we've heard today from earlier presentations that the industry is at a critical juncture as we strive to supply the critical metals for the world desperately needs to decarbonise the economy. And there's no more important metal than copper. It's the most viable and efficient conductor of electricity that we have. I knew I was missing something. That'll work, thank you. So let me tell you a little more about Sandfire and our journey as we progress towards our goal of being a sustainable mining company and a global copper producer of significance. But of course, first, can I ask that you take note of this important disclaimers in relation to today's presentation and all the associated footnotes in the appendix. At Sandfire, we have a very simple and clear purpose. We mine copper sustainably to energise the future. And I'll just pause there. That wasn't something that our board came up with or our CEO came up with or even the comms department for that matter. We went through a couple of years ago a process right around our organisation to get people's input, and what we landed on was this purpose statement. And personally I feel, and I know all of my workmates right around the globe feel, that this is a purpose statement that we can all connect to and a really unifying force. Sandfire is the largest copper-focused miner with a primary listing on the Australian Stock Exchange. We have strategic positions in 2 very highly prospective copper belts, the Iberian Pyrite Belt, which is centred around our Matsa operations in Spain, which produces copper with zinc, lead and silver byproducts, and the Kalahari Copper Belt in Botswana, centred around our recently constructed and commissioned Mateo operations, which produces copper with silver byproducts. Our strategy is intentionally simple, and it's designed to sharpen our focus around 4 key strategic pillars. Firstly, and most importantly, deliver safe, consistent and predictable performance, reducing our carbon intensity, increasing our reserves, which I'll talk a bit more about today, and while doing all of this with strong capital discipline. Now, rather than have a separate pillar around sustainability, we believe that our sustainability framework needs to be integral in everything we do, of course with safety at its core. And to bring our strategy to life, we've been reworking our operating model to make sure that we empower our people, we have clear lines of accountability, and of course, we have very strong values that underpin everything we do. So let's turn now to our operations. Let's start with Matsa, the premier mining complex in the Iberian Pyrite Belt. At Matsa, we have 3 underground mines. You can see here, Agustinitas, Magdalena and Sotiel, and a centralised processing facility with a 4.7 million tonne annualised capacity. And Matsa produces approximately 95,000 tonnes per annum of metal on copper equivalent terms. And you can also see on this slide, we have an extensive tenement package on both sides of the Iberian Pyrite Belt, the Spanish and the Portuguese side. This is an excellent area to do business. We have ready access to zero emissions electricity from renewables, which fulfills 100% of our needs. We have a very supportive government that places green energy and critical minerals at the centre of its economic development plans. And what's more, you shouldn't forget that the Spaniards have been mining metal from these hills for thousands of years. So we have a very passionate and loyal and supportive workforce that lives in the villages that surround our operations. In the 3 years since we've taken ownership, we've invested heavily in underground development and ventilation, which is starting to bear fruit aligned to our first strategic pillar. And by that I mean growing consistency and predictability and safety in our operations. And the business is now consistently achieving 4.6 million tonne per annum mining and processing rates compared to the 4.2, 4.4 when we took ownership. All of these achievements have meant that in the first half of financial year 2025, this translated into an underlying operations EBITDA of $134 million at a healthy margin of 44%. Matsa really is a quality asset. Our Matsa team have fundamentally rethought the way it thinks about our ore bodies. We've developed new geological, geotechnical and geometallurgical models. And this is in the 3 years since taking ownership. And this has been through a real back-to-basics approach, going all the way back to the core farm, relogging all the core, rebuilding models from ground up to make sure we really understand the geology that we're mining in this operation, because that underpins our value. This is one of the key opportunities we identified in due diligence, and we're so thrilled that it's really bearing fruit. At a strategic level, we've developed a multi-year exploration plan that you can see here on the slide with all the planned drill holes that's designed to identify new zones of mineralisation and convert our large resource base to reserves with the aim of having 15 years of life in front of the face within 5 years. And looking further afield, even though mining has occurred in this region for thousands of years, it is still relatively underexplored and we believe has potential for further discoveries. Our regional exploration team are applying modern geophysics and exploration techniques to identify and drill test targets. And of course, our well-capitalised modern mining complex undoubtedly provides us a distinct competitive advantage in this region. Turning to Mateo, which we think is really redefining the potential of the Kalahari Copper Belt. Our development of Mateo has established a high-quality strategic mining and processing hub consisting of 2 open pit mines, A4 and T3 that you see here in the picture, and a central processing facility right in the heart of the Kalahari Copper Belt. And like our position in the Iberian Pyrite Belt, you can see we also have a substantial tenement package right across the Kalahari Copper Belt. And we have an energised, passionate and most importantly local workforce that are really supporting our business as we move forward. On top of that, we have a stable democracy with stable fiscal terms. We really feel like we're fortunate to be an early mover in this basin. All of these elements and more have helped our talented team develop Mateo on budget and then execute an incredibly successful commissioning and ramp up of the processing facility. In fact, we've now shown we can operate the processing facility at 5.6 million tonne rate sustainably, which is far in excess, or well in excess, of the design rate, 5.2 million tonne. These achievements are a rarity in our industry today and something that I think the team over there need to be very proud of. In that region, we're working very hard to protect the environment, build deep ties with the local Hansi community and establish a local supply chain to make sure we're doing our part to support the government's drive to continue to improve citizen economic empowerment. Looking ahead, the completion of the A4 open pit development, which we mined our first small parcel of ore in December 2024, is the next major milestone for Mateo. It is an important element in getting us to our goal of sustaining metal production of approximately 60,000 tonnes per annum on a copper equivalent basis from Mateo for the foreseeable future. All of these outstanding achievements have seen Mateo generate an underlying operations EBITDA of $160 million at a margin of 60% in the 6 months to December 2024. And it's important to remember that first commercial production for this operation was at the start of FY24, so it's been quite a remarkable ramp up. And therefore we really consider that Mateo really is a jewel in our crown. And just like Mata, we see enormous prospectivity in this region. We have a plan we also have a plan which targets 15 years of reserve life within 5 years. And importantly, our understanding of the economic controls, or the structural controls of economic mineralisation, excuse me, I'm not the geologist, the structural controls of economic mineralisation in this region in the belt have grown considerably through one key fact. We've had the unique opportunity to mine A3, and there's nothing better than actually getting in and seeing what the structures look like. So what we now know is that asymmetric and isoclinal fault structures, such as you see in this diagram, are really important to the development of economic mineralisation in the region. And we've seen the same structures in T3 and A1. So we're now ramping up drilling activity, firstly to test the potential strike extensions at A4, which you see here, and we have an infill drilling program at our satellite A1 copper-silver deposit, which is aiming to convert the 5.6 million tonne maiden resource into a reserve by Q4 financial year 2026. At the regional level, we've completed broad-based geophysical and seismic surveys right across our tenure, and we've developed a basin-wide model which has identified multiple targets within the Mateo hub, within a trucking distance of our current processing facility, and more broadly across our tenure. And drilling activity is also ramping up to test these targets. So this advancement in our understanding of the structural controls for economic mineralisation in the region, plus our highly prospective landholding, means we're really excited about the exploration in this part of the world. In fact, we think we're only just scratching the surface. That brings us to the USA, where we're aiming to unlock hidden value at the Black Butte project. This is a fully permitted, high-grade copper project in Montana. The current drill program is designed to test the potential extensions of the higher grade Johnny Lee lower copper zone, which is now considered to be the primary driver of project economics. And you can see on the slide some of the recent intercepts we've reported to the market. In parallel to this drilling program, we're updating the study, which was last done in 2020, and that will support an update to our resource and reserve and ultimately advance the project towards development. Black Butte is a really valuable option in our portfolio. So hopefully I've articulated the quality of our asset portfolio, both the existing operations and the exploration potential we have around them. But let's move to the fourth pillar, demonstrate capital discipline. The safe, consistent, predictable performance of our assets, plus the healthy prices for the commodities we produce, has enabled us to deleverage our balance sheet considerably in recent times. Our net debt has reduced $193 million in the 9 months to December 2024. And this has other flow-on benefits. As we move closer to our net cash target, what we're seeing is more flexible debt structures that give us more liquidity and ability to handle cycles through the movements through the cycle. Importantly, lower financing costs and, of course, lower risk. Oh, what went the wrong way? I've been at Samphire now for 4.5 years, and I've seen us transform from a single asset company with what was our flagship DeGrussa asset in Western Australia to the company we are today. And I've got to say, Samphire is a very exciting place to be. We have a very high quality asset portfolio. We have highly prospective land holdings in the Iberian Pyrite Belt and the Kalahari Copper Belt. The medium and long-term fundamentals of copper, in our view, just keep getting better. We're well positioned to continue to grow shareholder growth through our 4 pillars, being safe, consistent, predictable performance, reducing our carbon intensity, importantly increasing our reserves, and of course doing all this while maintaining strong capital discipline. We are making strong progress towards our goal of being a sustainable mining company, and we've grown to be a copper producer of global significance. Thank you to Tribeca and the sponsors and the rest of the conference team for the opportunity to tell our story. We're really pleased to be here this year. I'm here this week with Tom Fu, who's standing at the back. He's our IR manager. We've had some great conversations with many of you in this room over the last couple of days, and we'd be more than happy to continue those conversations in our booth later on. If you'd like to see our presentation, you can please get it at that QR code. Thank you.
Thank you, Dave Wilson, and thank you, Sandfire. So we've heard from 2 solid copper stories now, and we're going to turn our radar to one that's building some serious momentum, a little bit under the radar. They're ticking all the right boxes for near-term production, long-term growth. They also have some serious leadership pedigree. And when I last read your news flow, sir, there's talks about that you're going to be, by the end of 2026, delivering 25,000 tonnes of it. Is that correct?
That is correct.
Well, this
thank
is
you
good.
very much.
Yeah.
We are
Wait, I haven't actually introduced you to everyone yet. Is that? I'm just going through the great things I read about you, and in light of what Terry was telling us this morning, that crunch is coming. So 25,000 tonnes in 26 is awesome. Now, this is one of those leadership people from this group with this fantastic pedigree. His name is Artem Volynets. He is the CEO of ACG Metals. So pop that one down on your ledger in front of you, and let's hear the story. Please make him welcome.
Thank you very much. Pleasure to be here. Thank you for your attention. Let us remind first as to why we are here. Copper is one of the future-facing commodities, probably more than others. ACG is designed to consolidate the copper sector through a series of roll-up acquisitions. We are small. We have a huge growth path ahead of us. Why the copper is a future? Very simply, in the next 30 years, the humanity need to consume probably as much as copper as has been produced since the beginning of human civilization. Yet, on the supply side, the grades are declining, as you all know. There are no new discoveries other than Robert Friedland's big Oyu Tolgoi deposit in Mongolia and Kamoa-Kakula that he discovered in DRC. Literally, there have been no new major discoveries in our sector. And yet, more than 50% of all copper mines globally is more than 30 years old. So we need copper. And yet, unlike other commodities, which are dominated by Chinese influence, nickel, cobalt, lithium, steel, aluminium, copper is well diversified both in terms of the supply and in terms of the demand, where it's consumed not only in construction but also in defense. Europe is going to spend big on defense now, as well as new sectors such as data centers for artificial technologies. Investors are recognizing that, and the pure-play copper companies are trading at significant premiums to the diversifieds. That's the reason we want to build a pure-play copper company. ACG, as it is about 6 months old. I listed ACG as a SPAC on the London Stock Exchange. We acquired our first asset in Turkey in September, put a business case together over the last 6 months, hired the team, signed EPC contract, raised $200 million in bonds to finance expansion from the current gold production, which generated us $76 million EBITDA last year, into production of copper. As you kindly said, 26,000 tons of copper from beginning of 2026. The last bit that we did before I started to market this company in the beginning of last week was reduction of the outstanding warrants by 75%, inheritance from our SPAC childhood. That it's done now, and I can market the shares. Why I want to market the shares? Because we are not an explorer. We are producing a lot of cash. If you think about the mining industry, mining assets are nothing less but huge cash printing machines. That's what we have now. Last year, EBITDA 76 million. This year, based on 2,300 gold, even though we'll produce less gold this year, as we eat through the oxide cap of our large deposit, close to 50 million, but at today's gold prices, it is very likely to be a similar number to the last year. We just raised 200 million. We have that on the balance sheet. Our project to transform into copper production is fully funded. Once we start producing copper from the beginning of next year, less than 12 months from now, EBITDA on the consensus pricing is over 100 million. At spot will be 120, and that's before any continuation of the gold production, which we will from satellite deposits. That means there is a massive upside in our share price. Why we are not there yet? Simply, the markets doesn't know about us. It's my second week marketing this story to investors. We've been busy putting the base case together. Today, we are trading at 0.2 price to net asset value. Comparable companies trading at 0.8 to 1. We are trading on consensus pricing 1.4 EBITDA, just under 2 times free cash flow. At spot, those numbers will be 1 time EBITDA, 1.5 free cash flow. I don't think you'll find another producing company trading at these multiples. This 4 to 5 times we expect to be in the next 12 to 18 months. Few words about the leadership. As you correctly mentioned, we have some fellow Singapore residents. Robert is an advisor to us. Henny Foyle used to be head of copper at BHP. At Anglo American. BHP is the company that wants to buy the assets that he built at Anglo American. The latest addition to the board, Mike Pompeo, former head of the State Department and CIA in the first Trump administration. Well, they say there is no such thing as a former spies. Very helpful to us in the countries where we're looking to buy the assets. I personally did the same strategy, executed on a similar consolidation strategy in aluminium. I was head of strategy of Rusal. I led all the transactions that created this company for about 10 years until I listed Rusal in Hong Kong in 2010, raising $2 billion at pre-money value of $20 billion. This time, we're starting with a listed vehicle on the main board of the London Stock Exchange. Our first asset in the western side of Turkey, 3 hours from Mediterranean Riviera, 3 hours drive from the 3 ports that will supply European smelters. Glencore has a copper offtake and a shareholder of ours. Traxys will have a zinc offtake, will produce 2 concentrates, copper and zinc. Traxys is a marketing agent for the zinc concentrate. The grade, as you can see here, is high, 2.26%, and that's what drives our position on a global cost curve. In both gold and copper, we're in the first quartile, meaning, again, lots of cash flow generation. The project we are currently executing on, which is a brownfield expansion from production of gold into production of copper, is about $7,000 per ton of copper capacity. Typically, you'll see new copper mines being built globally at 20 to 25,000 tons per copper capacity. We are fully funded. We don't need any more money. We have more cash on the balance sheet that is required to complete the construction, which is now less than a year into commissioning. As you can see, some pictures demonstrating that this is really happening. So what it means again in terms of value of the company, 4 to 5 times upside, whether it's a pre-capex now or post-capex starting from the first quarter of the next year. This is just the beginning. Organically, we have 2 sources of upside, which is continuous production of gold. We have identified additional satellite deposits not far from our main asset. We're doing drilling. I'm buying new licenses next week to continue producing gold, which means the EBITDA is not going to be 100, it's going to be 120, 140, 130, whatever it's going to be. On the sulfide side, we expect continuation of the life of mine, initial life of mine 11 years, but the previous owner just stopped drilling when they had 10 years for the bankable feasibility study. Already 35 to 40% of the resources we have in our balance, JORC resources, are outside of the initial pit shell, so we expect to access them once we go continue mining into the initial 11 years. Again, this is just the beginning. The next step for us is to continue adding producing or near-producing copper assets into our platform. We have a pipeline of deals, Turkey, Eastern Europe, Africa, South America, and the United States, which is very Trumpy topical now. We expect to be a producing company of copper. I think we have 2 to 3 years to execute on our M&A strategy before copper prices goes too high. The idea is to have 5 assets in 5 years, which globally in a number of jurisdictions, which will certainly make us a multi-billion-dollar company. Enjoy the ride. If you buy the shares now on the market, again, we don't need any more funding, and we have a number of investors keen to participate in this story as funders for our next transactions. Any questions? Very happy to answer.
You have 5 minutes. Would you like to ask? Actually, you know what I should do to my audio team? Shall I just grab the handheld mic? And if you can drag that one up to me, and we can actually pop around and ask questions. Has anyone got something they'd like to put to Wojtek at this point in time? Artem, sorry. Anyone at all?
It's okay. People should we can have a one-on-one discussions afterwards.
You sure? Okay. All right. Are you going to be here until the end of tonight?
I'm here until lunchtime, yes.
Just till lunchtime. Okay. So if you would like to speak to this person, one down here, wait for 1 second. Just say hello to everyone. Introduce yourself. Part of our networking here today, so we know who you are, and direct your question through. Thank you.
Hi, my name is Mudit. I work for AsiaMet Resources. We are a copper mining development company listed on UK AIM, but have 2 projects in Indonesia. What's your global mandate in terms of geography? That was one. Secondly, I think I saw it said stage of development, it said producing. But like, how do you see pre-production?
Our focus for M&A targets is producing or near producing. As I said, I think we have 2-3 years before copper prices go ballistic. So my goal is to accumulate producing assets, and after that we can go into exploration and development. Indonesia is supplying mostly China. Given the fact and the demonstrated with Mike on our board, we are focused on a Western supply chain. So that geography probably will not be on the top of my target list. Europe, Eastern Europe, Africa, South America, North America. But very happy to chat afterwards.
Anyone else have a question? I think we'll leave it there, sir. Thank you very much. So we've got morning tea to have a chat with you, and then you're off at lunchtime. Thank you so much, and thank you for presenting the ACG Metals proposition to us all. Another compelling story, and the story continues. We're going to travel to North America now. Now, when Terry got up and did the keynote speech this morning, he said that in North America, there's a few issues with permitting. Well, Magna Mining may have circumvented that. They've acquired a producing copper mine very cleverly, and they've added that to their nice little portfolio. So it's a strategic move. It really puts them as a significant player in North America's premier mining district, and this is their CEO, Jason Jessup, also the director of Magma as well. Please make him welcome, everyone.
Well, thank you very much for that introduction. I'm going to start off today just giving a little bit of background on myself and our company. So I live in Sudbury, Ontario, Canada. I've been there since about 2000, so about 25 years. Been in the mining industry for about 29 years, and Sudbury has been dominated by 2 major mining companies for the last 140 years. And, it's a long-lived mining camp. And those 2 companies were Inco and Falconbridge, which are now Vale and Glencore. So I worked for Inco from 2000 till about the end of 2004. And in 2002, a junior mining company came into Sudbury and were able to acquire 5 non-core past-producing mines from Inco. And in 2003, we're able to restart the McCreedy West mine and make some discoveries. In 2005, I joined the team there to lead the operations at the McCready West mine and the Levack mine next door. And we were very successful. We also restarted a third mine, the Podolsky mine, and by 2010, we were the best performing stock on the TSX of any company from 2000 to 2010. We were acquired, of course, with great success. Attracts a lot of attention. So we were acquired for $1.8 billion in 2010 to become Quadra FNX. I stuck around for about a year after that with Quadra FNX before moving on. And about a year after that, KGHM out of Poland acquired Quadra FNX for $3 billion. And primarily for a large copper project that Quadra FNX had in Chile. So I remained in Sudbury, and by 2015, I had recognized that these mines and these properties that were created so much value within a junior company in Sudbury were now non-core to their current owner, KGHM. And this is what inspired me to see an opportunity to recreate that entrepreneurial spirit with another junior company acquiring non-core assets from the majors in Sudbury. So founded Magna in 2016. In 2017, we were still a private company, made our first acquisition of the permitted past-producing Shakespeare mine. In 2021, we went public on the TSXV. And in 2022, we made our second acquisition of the Crean Hill mine, another non-core past-producing Inco mine, had produced 20 million tons historically. And from 2022 until 2024, we quickly moved that project ahead to become fully permitted, come out with a resource, sign ore selling agreements with Vale and Glencore, and complete a surface bulk sample. So our company had grown since going public quite substantially up until 2024, but that's when the real excitement started. And in September of 2024, we announced the signing of a definitive agreement to acquire the ex-FNX assets from KGHM in Sudbury. Assets that we knew very well, and we had built really our company to acquire these assets, recruiting many of my former colleagues from FNX into our team. So in February 28th, 2025, just a little over a month ago, we closed that acquisition to make Magna now a producing copper company with 4 fully permitted past-producing mines in the Sudbury Basin, as well as a portfolio of exploration companies. So it's a very exciting journey, but I think it's really important to understand the context behind how we got to where we are. There will be a number of forward-looking statements throughout this presentation, so please do your own due diligence. So for those of you who are not familiar with Sudbury, I'm going to just give a little bit of a background. It is a fantastic mining camp located about a 4-hour drive north of Toronto. It has a population of about 180,000 people. It has been mining for about 140 years in total, non-stop. It has all the infrastructure necessary for large mining projects and operations, including 2 large underutilized processing plants, 2 smelters, and then everything to support that, including an excellent university as well as 2 colleges to provide the skilled tradespeople and engineers and geologists needed. So Sudbury is a really great place to build mines, to discover new deposits, and to operate them. Because of the long history of operations in Sudbury, there is truly a social license to operate. The communities there not only support mining, they embrace it and they need it. And this includes our local First Nations communities, which are very much pro-mining and have built businesses around the mining industry, and they see the benefits from mining. But the reason why Sudbury has been an active mining camp for over 100 years is because of the geological endowment in the ground. Sudbury, I believe, has the potential to continue mining for at least another 50 years. It's truly spectacular geology. Since inception, we have built our company around 3 pillars of growth: production, exploration, and synergistic acquisitions. Now, with production, we have 1 producing mine, 4 permitted projects, so a steady growth pipeline that we can grow into what we believe will be a mid-tier producer in the next 3 to 4 years. On the exploration front, we have a lot of the former geologists that I worked with at FNX who had made multiple discoveries in Sudbury that understand this geology, and we have currently 5 drill rigs turning. We'll be bringing a 6th drill rig in shortly. So we believe great potential to make new discoveries and really meaningful material discoveries on our properties. And then with synergistic acquisitions, as I mentioned, we had made a number of acquisitions already in the Sudbury Basin, but we're not done yet. There are still other non-core assets in the Sudbury Basin owned by the major mining companies that we believe have great synergies with our existing infrastructure, and we are actively pursuing other acquisitions. You can never fully predict when these acquisitions can happen. They do take time, but there's definitely possibility in the next 12 months of announcing another acquisition. So this is a map of the Sudbury Basin. In black, you can see our McCreedy West mine, which is our producing mine. Next to it is the Levack mine. Levack is a spectacular mine, and I had the pleasure during my time with FNX at managing the operations at both of those mines. Levack is truly spectacular, a mine that's produced 65 million tons over a 100-year mining history, operated up until 2019. It's currently on care and maintenance. I was just underground there last week. And while I was operating that mine for FNX, quarter after quarter, we produced ore of 10% copper, 1% nickel, and 10 grams of platinum, palladium, gold combined. So very high-grade ore, spectacular mine, and it will be the next mine that we will be restarting. The Podolsky mine, another mine on care and maintenance, fully permitted. Our Crane Hill project was the one we acquired in 2022, and then our Shakespeare project, which was the first project we acquired, where we have permits and a feasibility study. So a great pipeline with a wide range of exploration properties around the basin. Our business model is to sell our ore to Vale and Glencore, and this is what FNX had done and KGHM had done since 2003. So both Vale and Glencore have large mills that are underutilized, and we have a very simple business model of mining the ore, sampling it on surface, driving it to their mill, dropping it off, and we have agreements in place to get paid. That allows a very capital-efficient ramp-up, and we do not have to build our own mill in order to continue to grow. As far as resources in the ground, we have 3 of our projects that have NI 43-101 compliant resources. We also have 3 other projects that have historic resources that we will be upgrading to NI 43-101 in the next 12 months. But of our NI 43-101 compliant resources, we have 48 million tons of indicated resource at these 3 mines, and we have, in total of those indicated resource, about 780 million pounds of copper, 742 million pounds of nickel, and 2.6 million ounces of platinum, palladium, gold. And these are at high grades. For example, at Crane Hill, our indicated resource is 3.55 copper equivalent. We have 18 million tons of that. At McCreedy, 9.3 million tons at 3.77 copper equivalent. And then our Shakespeare project, we have another 16 million tons at 1.31, and that's an open pit project with a low strip ratio. So great resources and potential to mine some very high grades within that. So the beauty of our business model, and then we're taking really a page out of my experience with FNX, is the McCreedy West mine that is now producing, and we've only had it for a month, so I can't speak specifically to production numbers and forecasts, but we will be coming out with guidance in the next few months. But we believe that we can take the cash flow from McCreedy West, reinvest that into the Levack mine, get it up and running as early as 2026, and then restart the Crane Hill mine and the Podolsky mine, and use this bootstrapped approach that all starts with successfully operating, generating cash flow from the McCreedy West mine. So we do have a lot going on. So I get asked, well, what are you focusing on? Well, we are laser focused this year in 2025 on getting the McCreedy West mine fully optimized and running at a production rate that we believe really respects that ore body. In 2023, it produced about 317,000 tons of ore at 1.6% copper plus nickel and precious metals. That's about half of the production profile it had when I was operating it through FNX. So we believe there's definitely an opportunity to ramp that up. So we are investing the capital this year, focusing on building out the mine opening up new workplaces and getting us set up for a very strong 2026 and beyond. At the Levack mine, we're currently drilling to support a restart plan, and we hope to have that restart plan completed in Q4 of this year, and that'll really foster and facilitate that restart we're hoping to do in 2026. And then we're evaluating the exploration properties we have that are away from the existing operations and prioritizing those targets as we identify them. So from an exploration potential, the McCreedy West mine has been operating for 22 years. It has a consistent track record of replacing reserves and resources year after year. We believe it's going to continue to do that. As I mentioned, 9.3 million tons of resources currently. We put out some results, drilling results, just earlier this week that kind of highlight the potential for high grade here. And there are many areas within the copper footwall zone that we are mining right now that have grades in excess of 8% copper over bulk mining widths. Now, again, we are working on increasing these production profile as well as increasing the grade back to similar grades that we saw during the FNX days, and we will be able to give more guidance on that later this year, but very exciting potential based on the drill results we put out. At our Levack mine, I think we even have more potential. There's an area very close to surface, and Levack mine has been mining for many, many years and is on care and maintenance, but an area called the Keel Zone. And this is a high-grade copper footwall zone where we have also released some results this week where we intersected 24.6% copper and 5 grams of precious metals within 200 meters of surface, just in behind our main ore body there. And this is in an area where there historically has been other drilling done. We believe this Keel Zone has a lot of potential for expansion, and the down dip of this zone goes to where we mined at FNX, the Morrison deposit, where I said we had been producing 10% copper and 10 grams of precious metals quarter after quarter while I was operating that mine. So very excited about that potential. And then in between our McCreedy West mine and the Levack mine, there's 2.2 kilometers of this same prospective rock unit, the Sudbury Breccia, that hosts these high-grade footwall deposits that has very little drilling in it. Where it has been drilled, there's been high-grade intersections, albeit narrow, but 30% copper over 0.6 meters with some precious metals, 280 meters outside of the existing resource. So definitely potential for more mineralization, and we will be drilling this later this year. So we have about 200 million shares outstanding, about a $300 million market cap, an excellent roster, a mix of institutional and retail shareholders. Management and the board, including myself, own about 8% of the stock, so we are very much invested in the company. And we perform very well, being one of the best performing stocks on the TSX Venture Exchange in 2024. As well, we've raised $54 million in the last 6 months in 2 separate financings, so we are cashed up and in a strong position to execute our growth plans. So why invest in Magna Mining now? I think there's a lot of good reasons. We're really just getting started. Now as a producing company, we believe that there are a lot more investors that we are opened up to and interested in looking at Magna. So that's what we're doing right now, and we believe there's potential for a re-rating. We have, as I said, 5 drills turning and a 6th drill coming, and that will, we believe, facilitate regular diamond drill results and assay results coming out throughout the course of this year. The ability to bootstrap and use cash flow to grow and organically grow, again, I think is a very strong indicator of the potential value within our company. That's not very often seen. And then again, the potential for new synergistic acquisitions of material deposits in the basin. So with that, I'll wrap things up, and maybe there's time for a few questions. Thank you.
Right on. Right on, Joseph. We have got no time for you to be asked questions up on stage, but you can go down to your booth and you can have questions asked you then. Would you please thank Jason, everyone? All right. We are powering through some hot copper runs, so this next one's got an interesting little core. It's got a nice little serious grade to it, and it's got a lot of bonanza grade copper at the surface. Yes, that's up in the north of Australia, up in Queensland, and down our southernmost tip in Tasmania, they've made a bold new play down there as well that we're going to hear about. The company's name is Inca Minerals. They're quietly building a serious copper story from the ground up, and this is their CEO, Trevor Benson. Would you please make him very welcome?
Thanks, Christina. So there's a few things to mention up front. This is a newly minted company through new management, and this presentation will be focusing on a new acquisition. The new acquisition is focused on a project up in northern Queensland, and it actually is very high-grade gold and high-grade antimony, both commodities trading at all-time highs. So please read the cautionary statement. So this, as I said, is focused on the new acquisition of a company, an unlisted private company, which has been in private. The assets have been in private hands for years, and unbelievably, this project has never been drilled. So, as I said, it's high-grade gold and high-grade antimony. And the focus will be on the project in northern Queensland. So the project, the takeover of this company opened on the 4th of March. It's a very exciting exploration program, and it's a simple story. We had a site visit up in early December, and we confirmed all the previous exploration results, and we had our own exploration program in terms of some soil and rock chip sampling, and confirmed the high-grade rock chips across the tenement area. So we have, in the rock chips, we have gold and antimony all over the vein systems, up to over 80 grams per tonne gold and 35% antimony. As I said, it's in northern Queensland, the main project, and we'll be drilling mid-year up there. We also have another project on the west coast of Tasmania, and that's an exciting base metals, gold, copper project, and we won't get there till the end of the year, but it's same rocks as the major discoveries and mines to the north of it, but I'll get to that later. There's an experienced board and management team, which I'll introduce you to in a minute. So the takeover of a company by the name of Australasia has been a success, and it's about to close tomorrow, in fact. And we would have gone to over 90%. I think we're at about 94%. So we're now moving to compulsory acquisition of the company, and I think we'll have 100% of it by the end of April. We've brought on a new geologist, and as I said, anyone coming on board as a shareholder will be leveraged to a refocused company. Obviously, Inca gives you the impression we're in South America, and the company historically was in Peru. All those assets have gone. We have some legacy assets across the top of Australia, and I'll explain those a little bit later on. So we're a very small company. We only took control of this company at the end of last year. We're experienced, seasoned in exploration and in resource development projects. So this is a new beginning for this small company. It's tightly held by our shareholders and supporters. So some of the board members you'll probably know of. We've got mining engineers. We have geologists. Brad Marwood's a mining engineer. Andrew Haythorpe, geologist, seasoned players. Brett Dixon's come on board as CFO, company secretary, fresh out of Azure Minerals takeover. And he's brought along a couple of money has come with him in terms of supporting and shareholders. And Gregor Bennett is our new exploration geologist that's going to oversee this very exciting program. And he's fresh from a takeover of his company recently. So the Australasia project, the company that we've taken over, has three main areas of focus, but our focus for the rest of the year will be in northern Queensland. We also, as I said, have the Mount Reid project on the west coast of Tasmania, and we have applications on uranium gold acreage in Western Australia. So this project in northern Queensland is about 125 k's west of Cairns, very accessible, and the previous owners have done a lot of good exploration work in terms of mapping, soil, geochem, a lot of rock chip sampling of these veins and porphyries that exists up there, but 75% of it's unexplored. So already we're looking at areas which have veins that are unmapped and further potential. So going a bit further into this property, as I said, these rock chips that we've taken out of this area are very high-grade gold and very high-grade antimony. You can see the veins in the photos there sticking out of the ground. They're visually, structurally significant, and they each of them runs up to, that one in particular is about 750 metres in length. So you can see that there's about 11 or 12 prospects that have been mapped, and we will be in there exploring in the middle of the year. We have to put in a couple of small little tracks to get access, but relatively easy, just making it slightly easier to get the RC rig in. But as I said before, this exciting project has never been drilled. It's in a province that's well known for gold discovery. This area's had about 40 million ounces taken out of it in history. You can see that there's major mines around us. There's gold occurrences everywhere. So it's an exciting area. It's Queensland government very pro exploration and mining, and pending the rain, we'll be in there towards the middle of the year drilling. So the previous work that was done, you can see there's up to 360 rock chip samples and grab samples, and across every prospect there's gold, high-grade gold in the rock chips. You can see some of those grades. You can see the high grades in the antimony. There are prospects that are predominantly antimony, and there's gold antimony. This is primarily a gold-focused exploration project, but we're very happy to have very high-grade, potential for high-grade antimony coming along with it. So obviously, as I've said, the Hurricane project is the jewel in the crown for us in this acquisition, and we did our own due diligence up early December and replicated ground truth some of the old work that was done and confirmed those grades, and also took new rock chip samples across all the major veins, and again we confirmed some very high grades, over 80 grams per tonne gold and 35% antimony, and good grades across all of those veins. So we're very excited to be getting in there and exploring mid-year. A couple of days ago we put another $1 million in the bank, and that'll be sufficient and good leverage for new shareholders to see the upside of any good results from the drilling. So we hope, this is obviously shallow epithermal system. We'll be drilling down to only about 50 metres. We'll be doing an initial 40-hole program, about 2,000 metres, and we should have some very good indications of where we're at after that. We have about 160 mapped drill collars at the moment, and we're focusing on the top 40 to initially. Some of the rocks that we've taken from our site visit, as I say, very high-grade gold, very high-grade antimony. The antimony is fairly visual in the stibnite, so we're very excited that we've picked up this project and looking forward to drilling it. So the forward-looking exploration program will be doing some extra geochem work, a lot more soils. We'll be doing. We're looking at other unmapped vein systems that have gold occurrences all over them. So the prospectivity of this area is enormous. 75% of it's untouched, and so there'll be a lot of work that's going on. We're currently organising this drill campaign as we speak, and as I said, we've already located the drill collars, and we're focusing now on the orientation of the veins and maximising the potential for success. The other package in the acquisition comes 224 square kilometres of Western Tasmania, south of Macquarie Harbour. It's down south of the major discoveries and same rocks as in the major operations to the north, Mount Lyell and Henty mines and Renison. So it's an exciting large tenement that we have. There's been an EM survey conducted over the entire tenement, and there's some very exciting targets that we will be accessing towards the end of the year, when hopefully we've got good reason to be still drilling up in northern Queensland. So very excited about the Tasmanian potential for gold and copper and other base metals. We also picked up these applications in Western Australia, and most people have heard of Mulga Rocks for uranium. So these are applications that have the potential for gold and uranium, and we will get to those eventually, but our focus is initially the first two projects. Inca has legacy assets that we have been in previous years exploring. We've mentioned that we are looking to farm out most of those projects because they are deep IOCG targets, and they are very much big company focused. So we're packaging them up and speaking to large companies with potential for farm out. We will keep the Macaulay Creek project in Queensland because that's got some exciting potential for copper. So we've completed a fair bit of work there, and we'll continue to work on that project. So Inca is a very small company. It has a compelling investment case in that it's fantastic leverage to a high-grade gold, high-grade antimony exploration campaign, very low share price and market cap. It comes with a refocus, with new management that have had some success in the past. It's certainly a value proposition, good leverage to shallow exploration drilling. As I said, this is only down to 50 metres, and we'll know exactly what we're in for. We think that this acquisition will re-rate the company, and we don't believe that its value is shown at the moment within the company, and there's huge leverage to positive drilling results. And as I said in the beginning, gold and antimony both commodities are trading at all-time highs. So a good time to be in gold and antimony. Thank you very much.
Well done, Trevor. Compelling story. Very interesting. Inca. Team, we're about to round out our discussion on copper. So one last play for your investment consideration, and then we're going to a panel session, and then we have lunch. And remember, Artima is leaving at lunchtime, so if you'd like to speak to him, you need to get in at... Oh, did I say lunch? It is lunch, isn't it? We're going to lunch. It's an extended period. Excuse me, because we had breakfast. So Terra Metals is our next player up on stage. They've been making headlines with their Dante project, which is over in Western Australia, revealing high-grade near-surface mineralisation that underscores some pretty significant potential, which is why you're smiling at me so broadly, I would suggest. So they've got some really good metallurgical tests recently as well, impressive recovery rates, and they're, I think, perhaps one of the main takeaways is your project's commercial viability. So I'm looking forward to hearing you explain that to us. So would you please put your hands together, everyone, and welcome the CEO and Managing Director of Terra Metals. This is Thomas Line. Welcome, Thomas.
Thank you very much. Just checking that's working. Thank you also to Tribeca and Scott Clements and the team at Vertical Events for putting on another excellent future-facing commodities conference. I was here last year for my first year, and it's great to be here again. Hope to be back in the future. So throughout the presentation, I will be making some forward-looking statements. The disclaimer is at the end of the presentation. It will be on the website, so please take a look at your own leisure. We are Terra Metals, and we are focused in West Australia on copper, gold, and titanium. We've made a large discovery. That's what I'll be speaking about throughout this presentation, and I'm looking forward to going through the details with you a little bit more here. So where are we? We're in West Australia, probably the best place on earth to do mining. It's super mining friendly. We have a range of different projects, but our core focus is certainly the Dante project, which is listed there. It's primarily copper, gold, and titanium, and has some really interesting byproducts as well that we think we can make out of the deposit. So in summary, the investment case for our company, we believe the 6 key points that really make it of great interest. We think there's potential for a large, low strip ratio, open cut mining scenario in the Dante project. We've got proven we can make 3 high-grade concentrates. The 2 key ones of those is a high-grade copper-gold concentrate and also a titanium concentrate. We're in the process of reporting our maiden resource, which we hope to have out soon. And apologies, this is not staying where it should, so I'll try and adjust it, but you might hear some rustling there. So the key concentrate we've made is a high-grade copper-gold concentrate, 28% copper and 17 grams per tonne gold, with a large amount of platinum in there as well as an accessory. Really good recoveries, over 95% of the copper, and really good recoveries of the precious metals as well. And we've also made 2 other great concentrates out of the same deposit. So this is a quick snapshot of us. I won't spend too much time on this, but we do have a low market cap at the moment of 8.2 million. Tribeca is our largest shareholder with about 15% of the company. So here's the Dante project. Now, I wouldn't normally put a slide like this into a corporate presentation, but for the Singapore conference, I've decided to put this in because in many of my discussions throughout the last few days, I've noticed that there might be some investors that don't fully understand the exploration phase and how value can be created. And if you listen to Scott Clements' presentation yesterday at the opening, he talked about how generational wealth is often created upstream. And that's certainly been the case in the exploration phase. And there is this lengthy process that happens before mining happens, where a huge amount of value can be created if you get it right. And this little diagram on the right-hand side here shows the process of exploration through to mining. And really, the most growth in a company happens at stages 1 and 2. And stage 3 is the final product, which is the mining. But I've just put a little case study down here to kind of further exemplify the point. And if you look back at Sandfire Resources in 2009, exploration company, eventually became a mining company, but they were in the exploration phase at a share price of 5 cents, and without undertaking any mining whatsoever, they made a discovery. 2 years later, they went 140x, so 140 times the share price in 2 years without mining a single piece of dirt. So this is the case in point that I'm trying to make here, that a huge amount of value can be created in the exploration phase of companies. Often it is far greater value than is created at the mining phase. The risk is higher. It's a different risk-reward profile, but that's what attracts people to opportunities like this. So how do mines become mines? Well, people have to find them, is the answer, and that's what we do. Exploration companies, we find new mines. We apply the science of the geosciences to do this, and we look at the geology and prospectivity initially using geophysics. You can see the magnetics geophysics image there. We do mapping, we find prospective rocks, the right types of rocks. We look at nearby major deposits. Are there other major mines nearby? Is the prospectivity high? And if the answer is yes, then we go out and we do ground truthing. We go on the ground and we start looking for evidence of mineralization of large scale that could potentially be an economic mine. So these pictures here you can see is me about 2 years ago, first going out to the project. I was the only employee in the company, and I was the head geologist and the CEO, so never trust a CEO who doesn't go out and get their hands dirty and go to site. And this was me basically going out and looking at these mapped mineralized areas and seeing if they are real. We have a handheld XRF, we zap the rock, it tells us if there's copper and other valuable metals in it, and we map these out and we confirm for ourselves if it's really there. So if that all goes to plan and there's actually only a few cases left on Earth where you get these big deposits sticking out of the ground. Most often you're looking at conceptual targets which are deep beneath the surface. But in our case, we have lots of this material sticking out of the ground, so lucky for us. And if that all looks good, then you go and drill. That's the next phase. This is the next point, a key point in reducing the risk of a project and proving if there's something there which could potentially be economic. Is it real? Does it extend beneath the surface? What is the geometry? Could it potentially be mineable? And how big is it? So this is us undertaking our first drill program. We drill the hole in the ground, the sample comes up, we analyze it on the back of a truck with our handheld XRF, which tells us what's in it, and we send the samples away and they get assayed. And if they come back with good things in them, then we get happy. And that's the discovery. So the next stage is if the drilling goes well, you make a discovery. Now, it's important to note that about 1 in 1,000 targets become discoveries, so it's quite rare for this to happen. The risk profile obviously reduces significantly in a project at the discovery phase, and this is the precursor to going into feasibility and eventually potentially mining. So this is where we are at the moment. We're post-discovery going into the feasibility level work, which includes metallurgy and other economic assessments. So that's just a bit of a precursor. Now to step back to the project itself. Here we are. You can see in grey, this is our project. We've just doubled the project, so it's over 1,000 square kilometres. It's a huge project. We've boxed up this highly prospective geology that is very similar to the Bushveld mining province in South Africa. We are surrounded by BHP and Rio Tinto and cobalt mining, which is Jeff Bezos and Bill Gates' artificial intelligence exploration company. So we're surrounded by majors, and we're this junior company in an island in the middle in what we think is some of the best ground in this province. And we own it all 100%. So here's some other images of the discovery. So you can see this mineralization is like a coal seam. It's a blanket. It's very simple. It's flat lying. You imagine if you laid a blanket out on the ground and it contained lots of copper, gold, and titanium. That's essentially what we have. It sticks out of the ground over more than 80 kilometers of length on the project. So far, we've drilled about 10 kilometers of that. And when it comes up out of the drill, it's black and heavy. So you don't need to be a skilled geologist to know when you've hit the mineralization. You can see here in this chart, this table, we're getting it from surface. We're hitting it from surface. So from 0 meters, you put the drill on the ground, you're hitting it straight away. So this is really good in terms of potential mining scenario project economics in the future, where you'd be mining into potential mineralization immediately and not having to dig through lots and lots of cover to get down to the ore body. So our focus, as I said, is about 10 kilometres so far of what is over 80 kilometres of strike on the project. Huge exploration upside in drilling the rest of that 80 kilometres. But we think these initial 2 reefs, Reef 1 and 2, have the potential to report a large resource, and the rest can be added to that over time with further drilling. These are very simple ore bodies. Like I said, they're like a coal seam or a blanket. You only need a little bit of drilling to convert into resource compared to other mineralization styles, and to upgrade those resources into higher levels of confidence. It requires a lot less work and a lot less drilling. You can see some of the grades on the left, on the table at the bottom there, we're getting. So, 0.74% copper, 18% titanium, with a huge amount of high-grade vanadium in there as well, and some platinum. So it's quite an amazing ore body, and we're very excited by it. And you can see on the bottom there, this is what they look like. Sometimes you get two or three of these things stacked on top of each other, which just means more ore volume, per unit area, which is really good for a potential open cut mining scenario as well. So this is essentially where we are now. We've done the drilling, we've made the discovery, and we're working through feasibility. And a big part of that is the metallurgy. We wanted to focus a lot on this. We've done lots of diamond drilling. And number one question people ask when you make a discovery like this is, well, you've got multiple metals. Can you get them out? And if you can get them out, can you do it in a way which is economic and doesn't cost much money? Can you use low-cost processing tools which are off the shelf? And the answer is, well, yeah, we think we can. We've just released our initial metallurgy about 2 weeks ago, and we've had excellent results. We've shown that we can produce a supreme copper-gold concentrate with a nice platinum credit in there, running 28% copper, 17 grams per tonne gold, and over 20 grams platinum, with excellent recoveries in the copper and precious metals. This is early-stage test work, and if you look at other peer companies who have done flotation test work at this stage, with these metals, these are excellent results. So this deposit is clearly amenable to simple flotation to produce a high-grade concentrate that would be expected to have a very high payability. The second thing we produced is a very high-grade titanium ilmenite concentrate. So this deposit does contain a huge amount of titanium. It has the potential to be one of the largest and highest-grade titanium deposits alongside with the copper and gold, which makes it a very compelling opportunity. We think the titanium is clearly a strategic mineral in the US and also in Australia, a critical mineral. It has many defense applications and is also used in a range of different commercial products. It's a $25 billion a year industry and is expected to go up over $30 billion at a strong growth rate over the next 4 and 5 years. So we have shown that using simple, off-the-shelf, low-cost magnetic separation, we can produce a very high-grade titanium concentrate as well. And that concentrate at 40% titanium exceeds the known producing operations in China and in Brazil and also in South Africa, who typically, as far as we're aware from our research, cannot produce a titanium concentrate at this grade using magnetic separation alone, and they require more expensive, complex processing tools. So it positions this deposit with an opportunity to be a low-cost curve producer with a very long mine life, open-cut style potential mining of copper gold concentrate and also titanium products. And the other thing that's of note here is that in the process of producing the copper gold and the titanium, what falls out of the metallurgical flow sheet for essentially no cost is a very high-grade vanadium concentrate, over 1.8% vanadium with excellent recoveries, which is well above the benchmark commercial grade for concentrate that can be achieved by a lot of the leading companies around the world. The major mining areas in the Bushveld and in South Africa, and also primarily in the Bushveld in South Africa and in China, struggle to get a concentrate grade of this at this level. So we're looking for a partner on the vanadium. We can't be everything. The copper, gold, and titanium is what we're focused on. We're fortunate enough that a super quality vanadium concentrate falls out of the flow sheet, and we're looking for potential partners on the vanadium. So this is what it looks like. You've got the black rock that comes up, and you powder it up, and then from that you can produce these 3 concentrates. So it's a diversified source of 3 critical mineral concentrates, which are high value, and we believe it positions us as a potential low-cost producer of these multiple products. There's some facts there on the different markets for people who aren't fully across them, but please do read it at your own leisure. Now, this is upstream, but the next stage would be downstream. So you do the feasibility, you mine the product, you produce raw concentrates, and those raw concentrates are used to produce a range of products which are actually used in real life, in everyday life. And when you have one of the world's potential, one of the largest and highest grade sources of some of these raw concentrates, it creates optionality where you can look at these downstream processing options, and you could potentially add a 6 to 10 X multiplier on the value of your product by doing some level of downstream processing, in some cases for not a very major increase in capex. So, this is something that a deposit like this provides optionality for. Titanium heavy mineral concentrate can be turned into synthetic rutile and titanium dioxide. which go to $1,800 to $3,000 per tonne. And vanadium can be used to make vanadium pentoxide flake, which is $9,000 or $10,000 a tonne, and ferrovanadium, much higher value products. But like I said, we've only drilled about 10 to 15% of this so far. We already think we're going to be able to define a large resource. The exploration upside on this project is immense. These things are sticking out of the ground over 80 kilometres. We think you could probably double that with what's hidden under a little bit of sand, and we're looking forward to drilling the rest of this project out and expanding the potential resource. And this is just us out on site. We're very involved with the community. We're very happy and pleased to be working with the Ngundarra community. They have approved several mine operations in the region. BHP are building, have half built a mine just to the south of us, 15 kilometres away, and spent $1 billion on infrastructure there in the last year and a half. And this native title community are clearly very supportive of mining and happy and want to see further opportunities in the region. So just in summary, we're strategically located. We're in a Tier 1 mining jurisdiction. BHP has made a large investment just to the south of us of over $1 billion Australian. We have excellent metallurgy and a large deposit, which we're working on a resource right now. We think we can report that resource with existing drill data, and we can make 3 high-grade concentrates with very good recoveries. And keep your ear to the floor for the next lot of updates. That's us. Thank you.
Good on you. Well done, sir. Well done. And a great way to round out our 6 of the best potential copper plays for you to invest in and add to your investing portfolio. Now we have got one presentation for you, one fireside chat left for you, and then we're going to lunch. We've got about 55 minutes for lunch today, so you've got a really nice sizable chunk of time to go and ask those questions. And if you would like to organise a one-on-one meeting, you can grab those apps as well on the app, and you can organise a meeting there as well. Or you can go to the check-in counter and you can organise a meeting there. Okay, so our panel for our next fireside chat, title first, Battery Materials, Betting on the Long Term and Surviving the Short Term is the headline. And our moderator is Anthony Z, who is the founder of Neo Capital, leading the charge up onto the stage. Welcome to you, Anthony. And joining him are John Worth, Jessica Fung, and David Christensen, who you met yesterday. David, of course, is from Renascor. Anthony, I'll let you do the introductions. You've got 30 minutes. Let's make this a great chat. And if you've got anything to ask, I don't have that spare microphone, so you can, you'll just have to yell out the question if something really grabs your interest and you would like more of clarification from our experts. Thank you all so much, and we look forward to the conversation. Please make them welcome.
Thank you. Thank you very much, everyone. I think I'd like to probably just allow my panelists to introduce themselves and their companies and their scope of business and project activity. So maybe John, starting with you.
Thank you, Anthony. So I'm John Worth. I run a business called Geo40. We're a little bit unusual. We're a DLE company, but we have a mature business in silica, extracting nanoparticles in New Zealand. So the distinction for us is that makes our journey in the lithium scale up perhaps a little easier than others. So very focused on North America. We've been running around piloting on all the produced water aquifers in the US and Canada for the last 12 months. And we're right in the middle now of building a 300-tonne per annum demo plant. So we're scaling pretty fast in DLE.
Great, thank you. Jessica?
Thanks. So my name's Jessica Fung. I'm the head of consulting at Project Blue. We are not a mining company. We are a market research and consulting services firm. We cover 30 critical mineral markets with 40 analysts located in the UK, South Africa, and China. And some of the work that we do for our clients include market studies for technical reports. We will do due diligence for investors and lenders. And obviously in the recent environment, we do quite a bit of consulting work for governments as well on critical minerals and pricing scenarios.
Great. Thank you, Jessica. David?
I'm David Christensen, Managing Director of Renascor Resources. We're an Australian-listed minerals development company now involved in the critical mineral space with our large-scale graphite project in South Australia. We're looking to produce both a graphite concentrate and then refine it into a spherical high-purity form that can be delivered to the lithium-ion battery sector.
Great. And I'm Anthony C. I'm a founder of Neo Capital. I'm an active investor up and down the battery value chain. previously actually ran a company called Galaxy, which became Allchem, and then Arcadium, which is the world's third largest lithium producer, which recently got acquired by Rio Tinto. I'm actually also the chairman of Nano One, which is actually a cathode materials company listed in Canada and actually has a operating plant in Candiac, just outside Montreal in Quebec province, and looking to build cathode capacity in other parts of the world. But today, really, kind of the focus is on my panelists. I'm here to moderate, and with that, I think I'd probably like to kick off with first round of questions. What are you seeing in the market at the moment, and what do you think of the status quo, and basically what keeps you up at night? John?
Look, it's super interesting, isn't it? We've got a very low price environment in lithium, and I think that is, it's robbed the sector of a little bit of pace, right? So we've seen people who could be moving much faster just back off a little bit. And the irony of the low price environment is, and we'll talk about price later, but when price comes back on, it's the well prepared who will catch the worm. And I think what I mean by that is that if you think about marginal supply in lithium, amongst the hard rock producers, bringing on marginal supply is really, really difficult. And I think that's the promise of DLE. If you're working on brines that are flowing now, you can scale very fast. But you should do that scaling work now in a quiet market so that when the market recovers, you're there to provide that marginal supply in a very attractive environment. So, what keeps us up at night is there's not much capital in the space. It's been really tough on the junior explorers. It's been pretty tough on the tech guys too. And I think the promise here is for the big oil and gas guys who've got these produced waters to fill that void and actually help the scale journey so that when the price is back on, we're building fast.
And we've seen some of that activity, right? Especially in North America with the likes of Exxon, Equinor, Oxy now stepping in to kind of help develop junior projects and help with the balance sheet, right?
Look, exactly right. I think there's a number of those guys starting to see that opportunity. We're seeing the same thing in the Middle East and across the world. And it's the oil and gas guys that are leading that charge. So I think for a junior sector, if you can attract an industry like oil and gas, it can help you through these times.
Great. And then, David, in your particular vertical in graphite and anode, obviously, as the world, continues to want to move towards, whether we have the geopolitical overhang or not, I think everyone appreciates in a post-COVID environment, it makes sense to have more diversity in the supply chain. The flip side of that, it doesn't make sense, to have 80, 90% concentration of anything. Whether it's PPE, face masks, pharmaceuticals, or in your case, graphite and anode materials kind of being dominated in particular in China. And outside of China, there's only really a small handful there. So, what do you see as the status quo in your particular vertical? And, that's kind of giving you the kind of keeping you up at night as well.
Yeah, look, I think the title of the panel is good, right? Long term, but survive the short term. I think the short term is nobody's making money in this business right now. And I mean not just the battery minerals companies who are suffering because the share price is down, but our customers and our customers' customers aren't either. So in our space, we see it with the anode customers, who are all operating at low capacity and are selling their product for about half of what they're selling at 2 years ago. But it's the same with the cell makers and same with the EV makers. There's a confluence of factors that have caused this, whether it's sort of inflation and pulling down buying power for consumers, or it's sort of the uncertainty in geopolitics, which I think is code for the Trump tariffs and what do we do next, because that's making it difficult to make capital investment decisions, even for investors who want to go long on it, because there's too much uncertainty. But then the backdrop to all this is I guess, the Chinese domination, which you've alluded to. And the impact on that is twofold, because it's not just that the Chinese are sort of dominating and increasing their market share, it's making Western projects less competitive, because the entire cost structure is difficult. So I guess what we see this isn't sustainable, but we really don't know when it's going to stop. right? And that's, I guess, if anything keeps me up at night, it's that, because we don't know. We can look at it, we can say, look, the Chinese can't continue to do this forever, can they? Well, no, I don't think so, because even the Chinese companies are losing money. So in the anode sector, we see defaults on debts amongst anode companies, and they're not getting their margin. They need the Western markets just as much we need the Western market. So we don't think it's sustainable, but that's the reality now. And I guess we survive this by trying to make smart capital decisions in the short term, but then do what John says, try to position ourselves to leverage up. And we do see some people involved in the sector are getting ready to do that. I think we all expect we're going to see, in particular in critical minerals, in things like graphite and anode, we're going to see ex-China prices, but we don't see that now, so we need to get ready for it. So the challenge is how can you survive getting ready for it and leverage up? But I guess from an investor standpoint, it's a good opportunity to come in, but if we're being honest, we don't know when things will change. We know that they can change quickly, but we need to sort of deal with that uncertainty before we see the light at the end of the rainbow.
So David, you touched upon policy measures in different parts of the world, and in your particular segment, we've seen that 15 months ago, China announced that they intended to put restrictions on exports of not only products but also potentially technology, and I think that is the same in lithium processing recently as well. So in the context of that, did you see that announcement on graphite and anodes really play out in reality? And then secondly, obviously, President Trump has recently announced a whole swath of tariffs. Is tariffs good for our sector and good for, I guess, battery materials in general, or is it a negative in your view?
Yeah, look, I guess there's a lot there. So did the Chinese restrictions, and so sort of they've gone through 2 rounds of announcing export restrictions that haven't been enforced. So no, it didn't have any impact at all on price, and the materials flowed. With respect to tariffs, tariffs are interesting because I think a lot of us might look at the Chinese and say they're subsidizing, and a fair response to that would be selective tariffs. And that seems like a policy tool that's been talked about for some time but hasn't been enforced. So the U.S. put some restrictions on foreign entities of concern, but then they exempted graphite for 2 years, and so the Chinese just kept on increasing their advantage, and the Western companies were losing it. But I guess what we're seeing now with tariffs is uncertainty, right? We've all, if anybody's figured out the announcement from last night, let me know. I'm still working on it myself. We don't know. I mean, these tariffs across the board is just creating uncertainty right now, which adds to sort of low price and uncertainty, making it difficult to make capital decisions. But as a selective policy tool, I think tariffs that are directed specifically at areas in which any group is giving state subsidies makes perfect sense. What we're seeing now seems to be a bit broad, but quite frankly, it's really hard to understand.
Okay. So, Jessica, we've heard our colleagues kind of talk about, the need, alas, the lack of capital in the market at the moment. And, given your client portfolio is a mix of strategics, other companies in the sector, as well as financial investors, what is it that you feel, what is on their minds at the moment, and what is stopping them kind of getting their checkbooks out, whether it's a more longer-term multi-year strategy or it's an investment that they're evaluating at the moment and doing due diligence that you guys are supporting them on as well?
Yeah, that's a very good question. I think there's a couple of things that our clients are looking for. One is, and I think this was alluded to by both of you, there needs to be consolidation in the sector. It grew so quickly, particularly in China, in such a fragmented way, that it is very difficult to make money in a fast-growing industry when you build so much overcapacity. So one of the things that we're looking for is consolidation. If you remember, the steel industry in China underwent this probably a decade ago, and so I suspect we will see that as well in the battery industry. In the critical minerals in general, we are seeing that there are policy announcements and regulations in China that are trying to consolidate the industry a little bit, not have 200 players, but let's have a reasonable number of players in these very, very niche markets. So that's one thing that we're starting to see play out, and sometimes it happens quickly, and sometimes it takes a while. And so that's what clients are waiting for, and certainly we've seen it in the lithium space, right? We've seen some consolidation. From a bringing out the checkbook perspective, we are seeing not a decrease in risk appetite at all. So from a lender perspective, if they've got a strategic view on this industry, they are still happy to look at investments. Certainly governments are much more willing to put funding up, but that needs to be matched by the equity side, which is a little bit of the tricky part right now. But what we are doing a lot more work on is detailed due diligence. So, 8 years ago, if you had said, I'm building a project, it goes into the battery industry, it's a hockey stick, fantastic, got a lot of funding. We had a whole SPAC, let's call it, thing where a lot of money and valuation got thrown at these industries, and now we're seeing how much it struggles and how they haven't been able to keep up. So on the due diligence side, it is no longer good enough to say, we are feeding the battery industry, we are feeding the energy transition. Now it is, okay, this is the product that you're going to produce, what are the specs, and who is actually going to buy it. So we're doing a lot more detailed supply chain analysis to say who are the exact customers, what are they looking for, what does the qualification process look like, what are the prices that you can actually receive, because there will be discounts for different specs, there will be premiums for certain specs. And then of course with the tariffs now coming in, there's a whole other ball game in terms of pricing scenarios that we're working on. So it's just, it takes more time for the due diligence, but I think the appetite is still there. I think the structural change in the world is still acknowledged, and the strategic necessity of this is still acknowledged. It's just taking a little bit more time now, and we're waiting for some consolidation, so profitability comes back.
I mean, it sounds as if the evaluation process is a lot more considered. From what I'm hearing you say, it's a range of technology readiness, product readiness, client acceptance, even business readiness, right? Some of these projects, some of these companies are, doing large-scale commercial projects for the first time. And I think if we look around, even over the past 12 months, whether it's in North America, we've seen companies either pivot, we saw the likes of Freya move from a cell manufacturer into basically a battery energy storage and a solar company. You've seen other companies, unfortunately, hit the wall. We've seen that in Europe as well, with Northvolt, which, for a long time, I think a lot of people felt they were too big to fail. And I think, as David pointed out just now, China's not immune from this either. I mean, I think recently there was an announcement by Shanshan, which is, probably up until about 5 years ago was a top 5 cathode company, and got a major investment from BASF, a German company, and they had to go into administration and restructuring at the beginning of this year as well. So that consolidation or leveling off of over capacity seems to be happening in one way or the other. But, what is it that, what is the trigger or what is the marker if they tick all of those boxes that investors and corporates, because you could argue that from a value perspective and share price and valuations, we're bouncing on the bottom at the moment. So from an investor perspective, asset valuations, you're fairly downside protected, right? So what is it? What is the signal? What is the trigger that you think gets them over the line and actions some of these opportunities? Because obviously, if you wait until the market turn, are they waiting for the market to turn and therefore getting those price signals from the market that things are recovering? Because by then, the asset could be probably twice as expensive, 3 times more expensive than what it is now. So what is it that's holding them back?
So it really depends on where in the capital structure, right, these guys are sitting. So from a strategic perspective, as John mentioned, they're still kicking the tires and they're still looking around. But as you said, given that there have been a number of investments in early stage projects that haven't quite panned out, I think boards are slightly hesitant to necessarily make those decisions so quickly right now. So again, everybody's just sort of waiting for this to play out. Valuation-wise, I agree. I think we're at the point now where things are looking very, very interesting, but there simply isn't enough, I think, capital to go around and fund every single project. And so people are trying to be very, very selective. And it really comes down to who is your strategic partner? Is there any potential for government backing? Because now that every single government has a critical minerals list, and every government is trying to think about how to fund these projects, if you go in and you've got some kind of potential government funding, you've got a corporate who's looking at you, all of a sudden, and you've got lenders who are doing their due diligence, all of a sudden you're starting to put the pieces together. And so I think that's what it takes. And we've talked about this so many times. Financing a project is a full-time job, and sometimes you don't really like the terms, but if you really want to get a project built, you kind of have to take it. And so this is what I think a lot of our clients are struggling with as well when they're thinking about it.
That's great. So, John, back to you. It seems as though there is a potential yellow brick road to pursue. There is light at the end of the tunnel, and to use an Aussieism, hopefully it's not an oncoming train. But, what do you see as the main opportunities and challenges along the way? I mean, Jessica touched on a couple of things. Financing obviously is important because you don't put dollars in the ground, you don't get the metal units out, right? Whether it's processing or resource. But what do you see as the challenges, but also more importantly, kind of, the opportunity if you can kind of, navigate that path and as the title of the panel says, kind of, survive this kind of somewhat prolonged valley of death and come out the other side?
Look, I think the flip side of a period where you've got a down market is and it is an opportunity, right? Is you're seeing some much needed aggregation in the sector. So you're seeing small resources get merged with larger resources. We know it doesn't matter whether you're mining copper or doing lithium brine, right? Scale is your friend, right? That's what makes your project economics better. So we're seeing that happen now, and some of that's a bit tough as poorly funded companies go to the wall and get gobbled up by better funded companies. But in lots of ways, that's actually good for the sector, right? So I think that's an opportunity that the guys that are active in the space and have capital to deploy, they can do that now at very low valuations and build for the future, right? So that takes a bit of tenacity and a bit of belief in the thematic. And we've got some investors on our register who are showing that belief and are out doing those deals, which is great. Look, on the challenge side, I think like any hot tech space, over the last few years, lithium attracted, or DLE attracted, its share of very promotional companies that made big claims, and we're probably a bit light on backing up those claims. So we feel that obligation very strongly, along with some of our peers. And we have an expression, in New Zealand, and we say, put your head down and do the mahi, which is the indigenous word for work, right? So what we mean by that is that, stop talking, shut up, and go out and pilot at the wellhead everywhere you possibly can, right? And we've covered 5,500 miles in North America, turning up with oil and gas companies with these two giant trailers and actually showing that DLE is real, it can be done at scale, and there are some serious players who know what they're doing, right? And I sit down with investors now who looked at us, 3 years ago and said, well, we're just not sure about this DLE thing. Is it real? Does it work? And now, of course, that's changed, right? And there's some very good companies out there doing it. And that's the opportunity to show that we can scale fast and really be that marginal producer when demand picks up, right? So put your head down, do the work, work with guys that are putting big scale resources together, bring together large resource with great tech, and there will be 3 or 4 great DLE tech firms that have emerged at scale. When you put those things together, you've got the best lithium projects on Earth, and we plan to be a part of that.
That's great. David, in your world, like during this kind of lull period, and I gather that you've also made a lot of progress up until now in terms of getting financing lined up, but obviously also being cognizant of, timing that recovery correctly so that as and when you may need to kind of access more capital, you're doing it from a position of strength. What are you and your team kind of, busying yourself on kind of during this period?
Yeah, so, as a mining company, we're used to the commodity cycle. You get boom and bust. When things are going well, you have to move ahead full speed and get going, and any step backwards is a failure. So everybody rushes and they want to build it as quickly as they can. But we know on the operating level that the path to getting something done is an iterative path where you go through many steps and you do have to take a step back and re-engineer certain aspects. We've reached the point in the cycle now where maybe the equity values are falling significantly below the prices of our commodities, and so the equity markets seem to be getting tired. And there's not a lot you can do to combat people's perception of the market. On the other hand, these are the kind of times when I think what we need to do is, I've said on a few of these panels before, we talk about financing and everything you need to do. Financing, I think, for critical minerals project isn't the challenge. Our challenge is price. But conforming with the financing requirements is quite serious. And so what we do now is we try to work a little bit harder on doing all of the engineering work, getting all of that work ready, and we all go through technical due diligence and things like this. That's not a full-time job. That's a full-time job for a lot of people. And it's not one you get a lot of credit for. You only get credit for once you are, sort of producing years later, right? And so what we do now is we do everything we can to ensure that all of our studies before are accurate. Like it's in particular, we did a DFS, so we've gone through an early contractor involvement with a competitive process with 2 EPC contractors to try to squeeze it as much as we can and make it as profitable as we can. Downstream wise is always a bit of a risk, so we are building a demo plant. And I think there is support out there, right? We have a grant from the government that's co-funding that. And, these are opportunities to try to get everything ready as quickly as you possibly can so that when the signals happen to turn the tap on, you're able to have, let's call it a first mover advantage or move as quickly as you can. But, these are the opportunities, I think, to do all of that sort of behind the scenes stuff so that when you execute, you can do it, I don't want to say flawlessly, but again, it's a boom-bust cycle. When everything is good, you got to move forward very quick. Mistakes are made. You can measure twice, cut one sort of thing, and I guess we do a lot of that right now.
And Jessica, for your, for your activities, how do you articulate that outlook to your clients? Obviously everything's challenged at the moment, but it's never really just completely one-sided. There are opportunities. How do you articulate that to your client base, and how receptive are they in terms of kind of like saying, okay, if that's the case, then let's do the work and at least get prepared?
So, obviously we don't identify specific opportunities to our clients. We just take the work that comes in. I think the good news is that we continue to build quite a bit of due diligence work across our entire client base. So whether it's government or industry or finance, companies, people are kicking the tires and they do want to understand what is happening in the market, what the outlook is. I think everyone recognizes that this will be positive in the long term. And really what they want to know is, what is the downside we need to be thinking about from here, which, to be fair, is quite limited. And what is the upside, and how do we think about risk? And so that's really the due diligence that we're doing. But like I said, the good news is that there is a lot of tire kicking that's happening, and people just want to understand it better. So the fact that there is a whole education piece to it, I think is quite positive.
And that's important, right? Because
exactly.
These are industry sectors which, for the better part of the last 2 decades, has not really existed outside of China, Japan, and Korea. So, many institutions and many government agencies and departments don't really know what these projects are about.
and especially the concentration of the supply chain and the fact that you've got an upstream, midstream, downstream, right? That was not clearly understood before, but it is definitely becoming headlines now, and I think that's the reason why interest is picking up. And so while we don't, again, identify opportunities, there are a lot of people that are becoming interested in it, who want to be educated so they can make a good decision when they're ready to make that decision. I also think the broader, macro picture of lower rates potentially coming in is also going to help the situation, because hopefully the liquidity will come, and it will come into strategic sectors like this.
So it sounds as if a more positive outlook is not necessarily a matter of if, but when. Okay, so with that, we've got a couple of minutes left. I'd like to probably just poll the audience to see if anyone has any questions for any of our panelists. If not, then I'll throw you one, which is one I get asked about a lot. Pricing and sentiment. How long do you think we're going to be bouncing along the bottom for, if we are bouncing along the bottom? What would be your call in terms of, are we 12, 24, 36 months out? Start with David.
Yeah, look, it's difficult to put a time on it, right? Because things changed, and when we saw the price declines from, sort of similar in graphite and anode, but I think it's similar to lithium as well. Sort of 2 years ago, things started to go down, and we didn't realize it was just not a minor correction until, sort of headway into it. I think what we've seen in some of the cycles already, in particular in lithium, is when it changes quickly. And I guess what I would say is, like, what we're seeing is, from our, say, customer base, they're already making investments for potential changes happening, right? And so our customers tend to operate a cost-plus model. They can't afford to pay more for a product unless their customer further down the line, who winds up being the EV manufacturer, is willing to underwrite that. Sometimes they're willing to do it, sometimes they're not. But what everyone's doing is everybody's trying to get ready for that right now and keep the optionality. And I guess that tells me it's going to happen sooner rather than later. And again, when these changes happen, they can happen quite quickly, whether they're because of policy changes or because of, say, the Chinese change their strategy on critical minerals in order to gain access to the Western markets. So yeah, I guess we would probably say we're already seeing the moves that are being made to make it happen. So that gives us some hope that we're not that far off.
Jessica?
So the last time we saw sort of policy come in, which might have been the austerity period, if you remember, after GFC, combined with a slowdown in China, which was, self-imposed really, was sort of in the 2015-2016 period. And at that time, if we think about the commodity prices, they were probably bottoming for a good 3 years, right, before they came out. Aluminum was slightly longer because there was, some financing issues there. So I think, depending on, how long you think we've been bottoming here, typically these types of cycles, really you bottom for a few years and then you're coming out of it, because everyone needs to work through and supply needs to get adjusted. But, the demand is there. So I'm not saying 3 years from now, I'm saying 3 years from when prices bottomed generally.
So John, which year, month, day, and time of the day do you think we're going to turn?
Look, I think you come back to how structurally difficult it is to bring supply on, right? Especially hard rock supply. So you don't need demand to shift much, and you add the geopolitics to that. And I think there'll be signs that we're going the right way by Christmas. We may not be where we want to be by Christmas, but I think that trajectory is what's going to help investors in the space. Let's get ourselves up into the high teens, and we'll see where it goes.
Great. So with that, may I ask everyone to give our panelists a big round of applause. Thank you for sitting in on our session, and thank you to my panelists.
And Anthony as well, to you for driving this panel. And Jess, you made a great observation about the importance of education, and all power to Scott and Tribeca for including the sessions like this. So we don't just have those opportunities with the companies that come up and talk to us. We also have we know what the drivers are, what the global drivers are in these different areas, so we can make wise investment choices. Thank you so much, team. I now invite you all to go to lunch. In fact, we can all go to lunch. We were going to have 55 minutes. We're now going to have 51 minutes.
Oh, okay.
But it was good. It was great content, so always worth listening to it.
You got to skip dessert.
That's right. So we've got 2 more panel sessions, hopefully of equal calibre to this one. We're going to start with one. We're going to look into Indonesia, see what's happening there, see if we're interested perhaps in going in there and doing a bit of investing. And we've got another one to finish off the day, and in between that, 6 more company presentations for your thoughtful inclusion perhaps in your investment portfolios. Let's go have lunch, have some more discussions. You'll hear the bell, and I look forward to seeing you all back in here again then. Thank you, everyone.